Trade Live with IG on Friday, the 26th of September, and we are joined by Aaron Bright. How are you, Aaron?
Very well, thank you. How are you, Anne?
I am very good indeed. Good to see everyone on as well. Good morning, Friar Tuck there. Gavin Ackers, I'm getting the Novo thing to use tucked in a sourdough, and I'll make sure that there is postage on. Thank you for reminding me. I have reminded Denise at reception about making sure they have postage stamps on things I send out to our clients. Aaron, did you hear about this? I sent something off to Gavin as a a prize because he won a quiz, and the reception forgot to put postage on.
Oh dear.
Yeah. Maturin, good morning. Hola. And Jugger, good morning to you as well. Shanta, hello. And Funky Gibbon, Wing It as well. And Carlo, wow, lots of you here. Parky 1977. Andrew McKilvey saying good morning. Go back above 2,750. Thanks. Yeah, I was going to say that's a bit low. 3,750. Right, welcome to the show. Let's have a quick look at what's coming up. Right.
Sure.
Ron, we're going to do overnight action opening bell together. Just give us a roundup of what you are expecting to cover, Aaron.
Yeah, so I think we're going to touch on, the news overnight with the digital IDs, as well as growing fiscal deficits and just general macro, like we always like to discuss. And then we've got Rich coming up at 8:15, tech focus with Pierce Buckworth, which is a replay. 8:35, expert edge with yourself and Bill Blaine.
Yeah, and Bill is going to give us a sneak preview of his morning porridge that goes out every day in the morning. And any questions for Bill, please do slam it here, and also hit the like and subscribe button. I'll also take you through all sessions on the opening bell, or those that are not 24-hour yet. And we'll have Art of Investing episode 11 with Richie Rich, Mark and Chris Fellingham. Rich is currently in or heading to Oktoberfest. Do you ever do Oktoberfest, Aaron?
No, I've never done Oktoberfest.
I've never done it as well. Also, I don't know why Oktoberfest starts in September, but hey, it ends in October.
Yeah, I have to try it one year. I've been meaning to. Certainly like a good German lager. So maybe next year.
I'm not a huge lager drinker, but I tell you what, one of the things last night that did make me want to drink was actually what happened overnight. There was a lot of hubbub on the Discord yesterday, and we will do that in overnight action. But yes, I was pleased to see that there was a lot of action, which got me excited as well, because I'll tell you about what I was doing a bit later when we get to overnight action. Right, thank you. Welcome back to overnight action. And Ron, looks like US stocks had a bit of a shake-up, but they did end moderately lower in the end overnight.
Yep.
S&P sectors pretty much down. Is this a start or just a blip?
Potentially. I mean, we've seen I think it's 3 consecutive days of downtrend now. So a little bit of a worry. I think, you're looking at the P ratios of the US equity markets, and we were slowly beginning to get comfortable with sort of 23 times earnings. We're now at about 26.6 times earnings. So it begs the question, how much further can we go in terms of valuations? And are I guess sort of the more secular areas of the market, specific areas of the market, going to, like the tech and the AI areas, going to continue to grow their earnings to justify these ratios? Because we saw that with certain tech stocks over the past sort of 2 years, where Nvidia was trading, I think, at certain periods like 250 times earnings. It's now about 60 because it's managed to grow its earnings significantly. So I guess that's the double-edged sword. That's the tug of war that we're facing at the moment. Can earnings keep up, or are we at a place where the macros not pleasant and the earnings aren't going to be able to keep up based on that, and based on just sort of the blistering run that these companies have had?
Yeah. And it'll be interesting to see what they say when earnings season starts as well, because that's not far off. Given that we've seen initial jobless claims falling 14,000 to a seasonally adjusted 218,000 for the week ending September 20th. Given we've got other mixed data as well, showing that the US economy actually grew faster than previously thought in the second quarter due to strong consumer spending and also investment by companies there. There you go, just showing you this chart there. GDP actually grew 3.8% in Q2. Trader friends, any of you that think this was expected, do let us know, because I was expecting a slightly softer figure.
Yeah. Similar to what the UK posted, which was basically flat growth for a number of months.
It does, in real terms, feel like negative, does it not?
It does, certainly.
And this is coming after, the Fed cut rates by 25 basis points. That was expected. Its first cut since December, after, some signs of weakness from the labour market, which actually is still very resilient. So
likely to probably get two more, I'd say, before year end, which I think the market is pricing in.
Yeah. They better get a move on, is all I'm saying. Investors also looking ahead to some data today. I mean, do you care about the personal consumption expenditures price index? I mean, it's Chris Beecham is very, very clear about this as one that he is least excited about.
I echo Chris's view. I mean, I think the big ones that we look for are non-farms, GDP. Inflation's obviously been a massive one that we've kept an eye on for the past 3 or 4 years, given the fact that it determines the central bank policy. So for years prior to sort of COVID and the inflation spike that we've had, whether it's 1.5 or 1.8% inflation isn't the biggest mover for markets, but now it determines the interest rate path, which is absolutely critical to determining, financial borrowing, equity returns, and equity valuation. So those are the ones which I think investors are going to need to keep an eye on going forward, and they're going to continue to determine the equity path, the equity growth path, or fall path that we're expecting, as well as sort of just the general macro. What's going on in geopolitics?
Yeah.
What's the political situation like? Are we going to get growing deficits?
Yeah. And the question is, when does the party music start getting turned down, and when do we see the rush for the exit, right? Because we've been here many times before.
You're beginning to see it, arguably, I would say.
You think so? You think the music's starting to get turned down already at the party?
Yeah, it's whether it's being turned down, it's whether someone can just turn it up again, or we're just going to get a power cut and things are going to slow down completely. But I mean, you're beginning to see it with the unemployment data. There's definitely arguments that you're now beginning to see tariffs affecting certain areas of the US market, most particularly the goods market, appliances. It will seep into costs, and for companies, they're going to want to maintain strong earnings per share and strong profit margins, and they're going to have to up their costs, which is going to put the consumer under pressure. So you're beginning to see elements of that. I think time will tell to see how bad this gets, whether we can turn the music up again or whether it's gonna come down. And there is a little bit of room for maneuver for the US central bank, the Fed in particular, to cut rates, which could boost things a little bit as well. A little bit of a seesaw action going on, but I'm not comfortable that we're at a period where the data is wonderful and that we can say we expect equities to just go on this blistering run, for infinity.
Yeah, totally. And what I am expecting to see is sort of like a zigzag motion, right? So
totally.
Rick Bensignor, who is one of the top analysts in the US, if not the top, and I always keep in touch with Rick because I used to work on Times Square for my sins a very long time ago. But he has very, very clearly stated that we are just a few weeks away from the first decline. So I asked him to quantify what kind of decline are we talking about. Bearing in mind, we spoke, this is from him on the 21st of September. So 5 days ago, friends, just to quantify, because Ange is all about duration. I always ask people first, before you start talking, what is your duration? So this was from him last Sunday, and he was still expecting a 5 to 11% drop to start in the next few weeks. And has asked all his clients to plan accordingly. Bear in mind, he has also turned neutral on the dollar after months of being a bear. All 4 major indices in the US, he says, although it's nice we keep seeing these all-time highs, but we've seen this many times, been in this place before. Trees don't grow into the sky. So as you rightly say, likely to, whether it's a swift turn down of volume or whether it's a power cut. Right.
Yeah,
speaking of which, looking elsewhere, I'm sure everyone's got something to say about this. Have you seen this, Aaron? Compulsory digital IDs are on the cards. What do you think about this?
I mean, it's certainly something that's been on the agenda for well, I'd even say decades, because we saw Tony Blair in his premiership sought to seek to introduce a mandatory ID cards, which the Lib Dem Conservative coalition immediately took off the table and said it was a breach of civil liberties, and that was 15 years ago that it was taken over by first Labour and then this new coalition government. So Keir Starmer is obviously more aligned to that Blairite faction of the Labour Party, and I think that still has quite close ties. So it's not a surprise that this has been introduced. I think it's quite interesting to see the opposition we've got from pretty much every party, and it unites both left and right, the opposition. We've got someone like Jeremy Corbyn issue a statement really on the far left of British politics saying he opposes it, and then we've got Reform UK, Nigel Farage putting out a video saying he opposes it. So definitely a lot of opposition, and from their argument justified in the sense that there could be abuse of power with this, leakage of data, and they believe that it's not actually going to stop illegal migration. But obviously the arguments in favour suggest that it will clamp down on irregulated labour and those kind of things. But certainly a polarising issue, and interesting to see how this develops, because Keir Starmer is expected to make a statement as early as today.
Do we know what time, Aaron?
I'm not sure yet. I'm not sure of the time yet, but I expect him to make some kind of statement mandating this. Certainly controversial in the sense that it wasn't in his manifesto, in the Labour 2024 election manifesto. So that's another controversy, saying, because many people are going to say, well, we didn't vote for this. So yeah, interesting to see that, if this gets through Parliament, if he has a rebellion in his own party, because he's obviously got that huge majority in the House of Commons. But certainly an interesting scenario. And I think we were mentioning before that you've obviously had experiences with many different IDs and stuff.
Yeah, I have had experiences. I've lived in 4 different countries. The thing is, I am not keen on it, because it's yet another thing to carry with you. I know you're going to say, well, it's digital on your phone, but it's just yet another thing that you're going to have to provide, and the Wi-Fi is not great in some countries.
Yeah.
So then you end up carrying the card anyway. Let us know your thoughts, because I am very keen to hear what you think about this ID. I don't like the fact that lots of questions that don't actually relate to safety at all, and if the data gets into the wrong hands, right? We've seen the cyber hacks that have happened recently.
Very serious,
right? Never mind governments, but M&S, Land Rover, that's the most recent ones that come to mind. And
even Heathrow Airport over the weekend had a hack.
Yeah, and we saw what happened with CrowdStrike last year, right?
Yeah.
So
yeah. If that's personal data getting leaked to negative players, people who want to cause harm, very serious issue.
Yeah. So if you haven't voted already, we have a poll going on right there, because Phil's put his own, I'm dubious, only time will tell. It's Funky Gibbons saying, good call for digital ID. Most people share their details online or in some digital form. And we've also got several people coming on talking about Marvel maturing and saying Marvel tech on the rise. It's now at level of resistance. Will it break through? We will keep an eye on that for you. Caught Short also saying buying more Marvel on the dip. Right. Friar Tuck there saying another challenge for hackers. Compete to crack. That's right. A lot of the warfare, as we know, will be in the cyberspace because in the DSEI that I went to recently, the 4-day conference, which was in Excel, the biggest growth area in terms of space and exhibitor spend in the whole of Excel for this year's conference was in digital and tech. So there you have it, digital and tech.
And Palantir is likely to be a continued beneficiary of that, I would imagine.
Yes, and their stall, I noticed, was much larger this year. I haven't forgotten Pelican, Mo, and RSAX. I saw your emails. I'll be messaging you back with pictures from that DSEI show. David saying we already have NI details and passports. What more do they need? Exactly. This is what I don't understand. They already have the details, right?
I think that's the argument with that is, if there's people working without national insurance numbers, the argument is well, if they don't have these IDs, then if they're working without NI numbers, they'll still find a way to sort of illegally work potentially.
Yeah. Let's cross over to the Times now because we've got quite a lot to get through. So the Times here, putting this up onto my screen, and here we are. So they are also going with that digital ID card story, but also reform on brink of outright majority if election were held today. This is not something new. Polls in recent months have also kind of showed that if there was a snap election, that reform would have quite a big showing. Of course, all this news coming on the cusp of the Labour Party conference. What do you think of this mood music?
Well, it's interesting that everything's coming out sort of around this time because there's rumours that, obviously it's no secret that Starmer's popularity is waning. I mean, it's been happening for a while, but there's rumours within the Labour Party that they want Andy Burnham to replace him, and then all of a sudden IDs are announced, and then one of his chief of comms is resigning. So there is a lot going on with Labour at the moment. So it's quite interesting to see all the PR around this, and then all of a sudden there's an article about reform likely to win a majority if there's an election, which is really interesting because it will be the end of two-party politics for the first time in well over 100 years.
Yeah, and also what's interesting too is that it comes in a time when Keir's had quite a storm. It's not just ahead of the budget. His head of comms has also left. Then there was that Angela Rayner tax debacle.
Yeah.
And so it's like the movie that keeps on giving at the moment.
It is. It is indeed.
What do you make of the fact that Farage is also now talking about how there might be a case for, Burnham being there, as you said, two-party. Burnham, interestingly, outlined a £40 billion borrowing plan, but Starmer hit back saying that the UK doesn't want to be beholden to the bond markets once again.
Yeah. Well, I mean, we actually saw bond yields rise yesterday because there's a lot of concerns with Labour's economic management over the past, I'd say, year or so. I mean, Rachel Reeves has got consistent criticism throughout her time as Chancellor from sort of both wings of the press. And I think the concern is just the growing gilt yields in the UK. And as this sort of deficit continues to grow, or if it does continue to grow, and the UK government obviously doesn't have a lot of headroom to cut taxes, whilst inflation lingers, there isn't that much room for manoeuvre for central banks to cut rates. So it's this sort of doom loop of growing gilt yields leading to more unsustainable debt, and yields get higher, debt grows, and I think that's the concern. And then Burnham, as you mentioned, is very keen to outline a large spending plan, which obviously the bond market is not keen on. And we saw that with Liz Truss famously, because even though her policies were very growth orientated, they were coming at a period of 8% inflation and interest rates being hiked. So the bond markets were really spooked out by that, and that's why you saw huge, shifts in gilt yields. And you're actually seeing gilt yields, the highest, particularly in the 30, 20-year highest since 1998, I believe.
Yeah, that's
And
right.
it's all sort of a culmination of um, growing debt and growing concerns over debt sustainability.
Yeah. Let's also take a look at the front page of the FT. It's swamped with this FT investigation story. If you haven't seen it, I highly recommend it because it's really laid out really well. The Russian spy ship stalking Europe's subsea cables. So if you haven't had a look at it, it's about how they have managed to use satellite technology, and they've tracked this little ship, the Russian spy ship that they think is probing the vulnerabilities in NATO infrastructure. Very interesting stuff. What do you think about that?
Yeah, winter is coming, I guess, in terms of geopolitics. It's certainly not a great sign in terms of how things are going. And obviously, we've seen a little bit of a deterioration with the rhetoric between both Putin and Trump, and with regards to that. So yeah, a difficult period. We certainly haven't made headway in terms of ironing out peace with Ukraine and Russia and other regions in the world. So yeah, definitely a concern, and definitely a time where it might be sensible to have some defense exposure,
Yeah.
whether it's through ETFs or single stocks, because if this continues, there will be names that will rally on this. If they receive renewed contracts or increased contracts in terms of military infrastructure.
For those of you that are interested in this space, I can get Simon Tucker, the CEO of SRT Marine, on, which is a listed company. You can trade that on the IG platform. Let me know if you'd like me to get him on for you, because the company focuses on marine surveillance. That's SRT Marine. Speaking of which, let's move on now to tariffs, because Trump has announced 100% tariffs on branded pharmaceutical products. Now, we knew this was always going to happen. He talked about it last year as well. We always knew that it was next in the crosshairs. The story coming after he announced it in Truth Social in a post on Thursday, adding that exemptions would be given to companies building new sites in the US. So basically, the same thing he's done with all the other companies, get those sites and jobs back onto US soil.
I mean, for in my opinion, this is just Trump in a nutshell, protecting US jobs and reducing sort of hegemony sort of outside of the US, whether it be European in certain areas or Chinese in certain areas. And Trump is staying true to his slogan, where he really wants to prioritize American labor market and onshore American jobs. That protectionist agenda has continued, and we've seen it almost for a decade now throughout his various times in office.
Yeah. What's also key is, if you want to take a look at how to trade this, have a look at some Indian stocks. I'll make a post about it later, because if there are these 100% tariffs, much of the pharmaceutical industry production as well is in India. In fact, I think if the data hasn't changed, and if my memory serves me correctly, India is the biggest maker of generic paracetamol.
That's
and
correct,
those sort of products. Lots of chat on the YouTube. I think France does too, and can't use to gain free access to public services. We've also got Maturin also saying something like at Steve, so that would be a Chinese company then. it's unlikely to be a Chinese company because of the security issues there. I can say that. So can Cam in the gallery. It'll be the French, as they already produce passports. Funky Gibbon on the pulse there. Remember way back when we had Brexit and Boris Johnson, the then Prime Minister, Ron, do you remember this? Said, we are going to put passports out to tender because it can't go to the same company the whole time. We're going to make it so that, we get a better, cheaper deal because we're going to move back to the blue passport. None of this red stuff anymore. We're going to go back to the original blue passport.
I've actually still got a red passport. Yeah.
Do you remember that?
Mine's still, yeah, absolutely. My passport's actually still red because it's hasn't expired yet.
I'm really jealous.
I think I got one of the last red ones because it doesn't expire for another few years.
I'm really jealous because mine's blue now. But what I was going to say is that the word on the ground was this huge tender process and everything, and they tried to cut the costs. And then what then eventually happened was the people that printed it originally still got the deal. They're the ones that print our banknotes. It's changed a bit now because I think they're being bought over by an American company, so they've given it to a subsidiary. But yes, the French seem to monopolize that space, so I'm not surprised if they end up getting it done for the UK if we go down that route. Right, we got to go to break, and we'll be back with the opening bell.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves. Welcome to The Art of Investing, a brand new podcast to help you achieve your investing goals. Join me, Rich McDonald, and my co-hosts, Mark Spice Holden and Chris C.J. Fellingham, every Friday when we bring you updates from the markets and insights from our combined 100 years of investing experience.
Hey, welcome back to the opening bell. we've got Aaron joining us to take us through the open. We've just got like a minute to go here. 15 seconds even. Markets navigating Trump's fresh tariff wave whilst we await this PCE data. 3, 2, 1. Here we go. Right. Charts up, charts up. We're out the gate there and it's looking early still, but risk on there. Aaron, what do you think? Let's have a look.
Definitely a little bit of risk on through various indices there. And if we look at the FTSE, look at the likes of JD, up about 1%, Crowd International so up 1 6/10%, and definitely a fair bit of risk on sentiment this morning.
Yeah, and we're seeing a lot of the miners also come back. Got Smith and Nephew, some of the defensives as well. NatWest, Lloyd's also on the winners list there. EasyJet is also flying slightly higher. Let's have a look at the losers right now. Aaron, take us through some of the losers.
Yeah, Rio Tinto down slightly, as AstraZeneca is as well. Both down just shy of 1%, or Rio Tinto just over 1%. AstraZeneca down 0.7%. Bunzl down 0.2%, and Unilever also down about 0.3%.
Let's cross over to France now to see how that is shaking out. France first, we got. Let's have a look at the winners there. EssilorLuxottica up 1.5%. Scotty Byrne must have bought his new glasses. LVMH as well. Look at you, Mr. Man of Luxury, is up 1% there. You like an LV kind of guy. Vuitton, the more expensive end. How about
like
somebody
Moet,
else? We've got defense coming back, Aaron. Thales up 1%.
Definitely, and I think this is probably based on some of the articles that we saw this morning and that we were going through about, what's going on in the world. We need to be a bit more defensive.
Yeah, let's have a look at the losers now. We've got Teleperformance down more than 4% there.
Yeah.
We've also got BNP Paribas, ST Micro down 1.4.
Dassault is down just 0.2%.
Yeah, and let's have a look at Euro over to Germany. Let's have a look there. My screen. Here we are. Got Deutsche Bank up 0.75%. The reinsurers, Munich Re up 1.3%. Siemens also higher. Looks like banks are rotating back into the black.
Yeah, definitely. Really interesting movements we're seeing there.
Yeah, Porsche as well, up 0.75%. They're coming back and easing off the pressure they saw earlier this week when they were lower. Adidas also up 0.2%. Switching over to the losers, what do you make of that, Aaron?
Yeah, some of the bigger names also having a bit of pressure this morning. Bayer is down 2%. Beiersdorf down 0.4%, and Rheinmetall is also facing a little bit of pressure, down 0.1% there. So some big moves in some of the fallers there. Not massive, but we're seeing a little bit of pressure. Even though I think in general this morning we've seen a bit of risk on appetite across the indices and stocks that are trading.
Right, if you come off my chart there, I'll have a look at my filters to see what is going on there. We've also got quite a few comments. Aaron, are you able to read out some of the comments for me there?
Yes, absolutely. Let me get my phone up. So in terms of the digital ID, we've got some interesting comments. Steve Davies, big issues like ID cards need another referendum. Let the people decide.
Oh my God! Remember what happened the last time we let people decide?
Yes. I've got one comment here. What other countries have ID cards? And Jugger said Germany does. Cucumber said North Korea and Sudan. George Orwell is shaking in his grave. So I guess a nod to the concerns over the poll. And the results are in. The poll has ended. So we have the poll was, what do you think of digital IDs? 49% said not for me. There are security risks. 33% said we're in a digital age. I agree. and 18% said I'm dubious, only time will tell. So I think that the majority is people aren't so keen on them or aren't so sure of them, which is quite interesting. And we also have there is a petition going around which I saw yesterday. I think I saw it on X, and it had 100,000 last night saying, opposing digital ID rollout. There's now over 500,000 signatures from British people. So really interesting to see the sentiment is across both political wings is not that supportive of them.
All right, let's take a quick look at Novo Nordisk, because my filters are starting to blip and lots of red lines coming through. So we got Novo Nordisk shares there down about a percent there after the US said it was going to impose 100% tariffs on branded drugs. As you can see, this week I've been telling you about Eli Lilly, whenever it announced that it was going to, have this big manufacturing plant, especially in the US, its shares got a bit of a lift there. Let's have a look elsewhere too. Daimler is the other one to watch. Daimler Truck, more specifically, down 3.8% there. It's revving, or not revving, it's actually reversing, because this is down to the tariffs that the US is imposing on heavy duty trucks. So this leads me to think, right, where else in this universe will we see losses? And it's Traton, Jugger. Let me know if I'm saying that right. Traton, which is another maker, of course, and also the other one is Volvo. Let's have a look at Volvo there, because we're likely to see a reaction. Not much on Volvo, but let's have a look at Daimler Trucks again to see, because I think it was down some 3.6% there. Look at that reaction. Any others that have caught your eye, Aaron?
Well, I think ones which continue to catch my eye over sort of the coming months. I mean, Rolls-Royce has just been on an absolutely blistering run, and I think we're seeing pretty much the continuation of that. And on the downside, Diageo, if I take two British stocks, they're both rather painful. I mean, this is a positive, but Diageo on the other hand is a painful one. This has been quite incredible, really, since the run it's been on since COVID. But Diageo, really painful for many investors over the years, as we've seen really demand for alcohol fall.
Yeah, I mean, we've talked about this quite a lot, haven't we? The fact that Diageo really has not managed to corner the whole kind of zero alcohol boom and that trend. And the funny thing about Diageo too is that one of the is caught between a rock and a hard place. So Diageo has many fingers in emerging markets, and many emerging markets still drink more, but it's really the US market and the Western markets that have started becoming, shall we say, a bit more teetotal. It hurts me to say this. Hurts me deeply. Because I too have a position in Diageo, more so for its dividends as well, but also the fact that I'm a big fan of Guinness, which is what Diageo makes, and I think the 0% is a pretty good I
only tried Guinness for the first time a couple of years ago. I was always more keen on the lager, but I'm a big fan. I really like it, especially as winter's coming up. It's a very soothing winter tipple, I guess. Yeah.
Let's have a look at Ralph Lauren as well. Ralph, I'm not seeing anything there, but we've got Avens, and that's moving too. Elsewhere, it's looking like a pretty quiet morning so far, but friends, just be aware, have your trading mitts on, because as I said, we had Rick Bensignor in his note saying that we could see a bit of a correction in the coming weeks.
Definitely.
No one really knows when. If we did, we'd all be in the Bahamas. Looking at the commodities space, we've got natural gas up 1.6% there. Oil as well, WTI And pretty much
Gold's
up
falling a
slightly.
little bit in the precious metal, but I mean, still on a pretty much a record high level, or there and thereabouts, still at pretty high levels that we've seen, over the past 5 years or so, really at massive levels.
Gold is still holding its ground, even though the Fed rate cut bets are sort of easing, but all those tariffs and the uncertainty, the tariff uncertainty and geopolitics, giving pretty good support to the yellow metal. It's not just the yellow metal that one should watch. So I got a message from Peter Hambro of the mining dynasty. Those of you that watched his interview, thank you so much for your wonderful feedback. I'm trying to get Peter Hambro back in when there is no crazy TFL strike to prevent him from actually coming in. Loads of you were with me during that day. Peter's view is that actually, and the person that wrote this note is Niels C. If you follow this market, Neil is someone who is I put it in the chat after this. This is Editor's Picks at Niels C. Interesting piece from Kitco. Gold continues to attract investor attention, but it's playing third fiddle in the precious metals market as both platinum and silver are outperforming the yellow metal.
Right, I think from a traditional perspective, gold does have some room in the sense that, if rate cuts come and yields fall, that's less of an opportunity cost of holding gold. So that could be quite a positive for it. Yep,
totally right. And loads of people on the chat asking about guess the chart. What is with the different time? Where's the song? And have you not been strong arming Phil enough to get us the song with these special lyrics? Well, here it is. Hold on to your seats. And here we go.
I want you on my chart. Bring me that sky. I want you on my chart. I want to see you rise. Footsie's beating hard. The market never lies. Bring me the next shiny new chart. 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 Lloyd's and Tesco swing, Shell and BP shine, Barclays on the line. Bring me the next shiny new chart. 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 Financial advice, but the ticker sing from AstraZeneca to Rolls-Royce wings. We chase the numbers, we chase the spark. Guess the chart before the bell hits mark. Bring me the next shiny new chart. 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 Yeah, the bell's ringing. Yeah, the stock's shining.
Hello, welcome back. And wasn't that amazing, that song from Guess the Chart? Did you manage to guess the chart, Aaron?
I required a bit of help from Phil. My guess was wrong initially.
But Neil Brewster got it right. Well done you, Neil. In fact, David, was it David that beat him to it, Phil? David beat Neil just by a touch. Well done, David. It is indeed Tesco, and that is a beautiful chart there. Lovely applause for David. Yes, and it has been on a very strong upward trend recently. Another thing that has been on a very strong upward trend, or as Dylan says from Tasty, is silver. Yeah, hi-ho silver. Let's have a quick look at that. Any thoughts on silver, Aaron, quickly?
Yeah, I mean, it's done very well, but it's, I think, the more volatile area of gold, in terms of that precious metal space. So it tends to follow gold, but it can have quite a lot of volatility. So definitely one to tread with caution and to be aware of the risks with that one.
Yeah. But what's cool about spot silver, or silver rather, is it is at its highest level in 14 years. I'm going to try and draw this for you so you can see right there, the highest level unseen in more than 14 years. Also, Sachs, you wanted me to look at platinum very quickly because I know we have this replay coming up of peers, but platinum also marching higher. That this is the 1 hour chart, but showing the daily there for you. In terms of the chart, we always say don't fight the trend, and right now the trend is looking strongly up there. Platinum, while prices are, if you look there, remaining near that all-time high levels and also the peak. If I go back to monthly, near an 11-year peak, up 54% this year. Do bear in mind that platinum's gains have come in recent months as investors move down the value chain in the precious metals market. Right, I'll message you more, Sachs, on this, but we have to go right now to the interview that Rich had with Piers and myself with Piers as well earlier on in the week. For those of you that didn't catch it, here it is now.
Micron, yeah, I mean, listen, Micron we spoke about in the last, was it last week? Fascinating story in the fact that this is a cyclical semiconductor company that's Silicon Valley. It's been the center of Silicon Valley for decades and decades. It trades like that. It's very hard to invest in because of the cyclicality of the business, the DRAM and the NAND and the memory. This is a classic example where I just look at what's going on right now, and quite frankly, I have nothing but just regret because I've spoken to clients about this for probably 3 years straight about what about memory? Why isn't AI focusing on memory? We all know they need power. We all know they need GPUs. We all know they need cooling systems. But what about memory? They all require memory. It's just the facts. So why are the memory guys not getting their go over this?
And what was the market missing there?
And just the orders, because this is all just happening. So This is all happening in real time. So the orders started to flow in, and Micron has just completely re-rated because Micron is usually priced as if it's like that, but now it's being priced with just like a Nvidia type thing, right? It's just with consistent. They can see where the revenue is coming for the next 3 or 4 years. Now, listen, the stock has had. Everyone cottoned onto this about a month ago, and then there was an update about 2 weeks ago in particular, which caused all the analysts. There's a particular chip called the, where's my thing? I forget the name of it, MB15, I think it is. Okay. It's a new type of memory. So I saw 5 or 6 analysts come out with price targets above 200 when this was trading at 155 before the earnings, right? It was quite an unusual situation. Yeah. So the earnings had to be amazing, the guidance had to be amazing, and they were. But the stock's up, last time I checked, was up about 3.5% after market. I don't know what it's doing pre-market. We haven't got pre-market yet.
Not quite as spicy as that. We do. IG do 24-hour trading now.
They do. So isn't that exciting? So where is it trading then?
About 1%.
So exactly right. And that is exactly in line with what my thoughts are here. It was up 5. But then it's just exhausted because this is what happens and this is where the market shoots itself in the foot, where there's too much positivity into the print. Now, Micron's going to be a fascinating day because it's going to fight because it's overbought, it's very exuberant, there's too much positivity, but it's great numbers. So it might fight its way back to 3.5%, 4%, but then I would fade that move, and just in terms of short-term trading, but in terms of structural positioning on this company, you have to like it because it's coming from a base where no one was long, and that can correct itself over the space of years, not months. So
this kind of reminds me of an Oracle situation. Then,
kind of,
because
there's a
you
lot of
could
this
be
going
saying
on.
the same thing for Oracle.
Exactly right. And I'm going to use this opportunity to mention Marvell again, because this hasn't actually happened yet, and it will happen. No one's reading the tea leaves here, right? They're doing almost the same thing.
When we looked at the graph, first of all, if we take this bit out of it, that reminds me of Marvell. That is exactly the same chart.
Very similar, yeah. I mean,
especially year to date. So let's move on to that one. And do we have an update? Because this is recovered.
well, there's no update, right? I mean, the company haven't
Look at
spoken.
that. It's the same chart.
Very similar.
before
But the thing is, guys, is that this is one of the only, and this is what I specialize in, right? I am terrible at chasing crowded stocks. I miss out on lots of upside. I've got no interest in doing it. I never will do it. It's not what I do. What I do is try and find companies that haven't moved yet. And this is a great example of what something that I love, right? The ducks are aligned. We've heard what the company have got to say. We know what they do. The only thing is that they haven't quite got the orders yet. And my feeling is that is because they will have a Micron moment. It could be next quarter, it could be the quarter after, I don't know. But when they have that Micron moment, this stock will be well and truly beyond the highs, because I know that it's a retail favorite as well. Then the options will go bananas, right? And it will be up. I've seen it happen before. It's just a matter of time. So that's why I'm focused on that one. And also the price action is very encouraging. Yeah. Minus 18% on that sell-off on the earnings, which by the way was completely wrong. 58% revenue growth. Why is it selling off 50? It's crazy. It's much, much, much cheaper than some of the other stocks. Massive revenue clip. So it's quite rightly made its way all the way back to where it was.
Exactly
and now I think the market will slowly work it out. It'll just take an update from like someone, because the market is so thick. Actually, it doesn't think.
The market's always right, Piers.
It is, but it only trades the information it has.
Yes.
Not the information it doesn't have. And that's what you've got to get your head around. You think. It's good to be smart and think ahead of the game. That may be the case, but often it's not, because you have to wait for the news to be on the tape for everyone to feel confident to buy it. The analysts won't say anything until the news is on the tape. So anyway,
So we covered Micron, we covered Marvell. Let's go back to Oracle there. We mentioned it, but you do have quite a firm view on this at the moment in the short term.
Yeah, I just think it's overcooked. And listen, I mean, I totally see the argument for Oracle, and I agree with it. But listen, look what happened yesterday. Look what happened in the last 48 hours, right? The stock yesterday was sold off 5% on volume as all of the large AI capex stories reversed. When there was a Bain Capital report that came out saying that there could be an $800 billion revenue shortfall for all these big capex spenders, not receivers. And everyone started questioning what this AI NVIDIA deal actually means. And what it actually means is NVIDIA are now flexing their muscles, right? They've got we all know that they're the king's largest company in the world, massive amounts of cash. They're just buying stakes in everyone and flexing their muscles, trying to stimulate. The question now is, are they trying to artificially stimulate and expand their own demand path? Or are they doing the cleverest thing ever? And this is going to turn out to be a multi-billion-dollar profit for them. The problem is
both.
Or both. Question is, the problem is that the time frame now, right? We're 2025. The revenue projections are starting to hit in 2029, maybe 2030.
Yeah.
There's some big question marks, because we're talking about trillions of dollars now, right? It's a fine line that they're walking. We all know that AI is real. We know it's an industrial revolution. We know all this stuff. But what we don't know is exactly the scope, scale, and when the revenues are going to start to kick in for these guys. So Oracle's a different story, though. I mean, they're coming from a low base and re-rating, but I just think it's not going to just keep ripping higher. It needs to calm down a bit, in my view.
The management changes, the TikTok deal, it adds to the argument of upside in the medium to longer term.
Yeah, exactly. Yeah. And also, let's just talk about the valuation, right? The valuation on this, it was dirt cheap. It was on 26 times forward. It's now on 53 times forward. Okay, I'm talking about earnings. Now that is still incredibly cheap versus their growth profile if you look at a company like Palantir. But I think we need to remember, I mean, and with Palantir now, and we can talk about, is I've put that to one side, because I'm fighting something that's different that's going on here, and it's impossible to fight. It just is, right? You've got the CEO, Mark Benioff of Salesforce, validating their valuation, saying, I wish our products were given that premium.
Yeah.
Right, and that's a different way of thinking about it, right? I don't agree with it, and I still believe that the stock's going to have a day of reckoning, but I'm not going to fight it. It got 3 more upgrades yesterday. Bank of America moved it to 215. They did.
So that was yesterday's up 1.5% move when everything else
sold off. Palantir was up yesterday. Bank of America upgraded, and there was a deal with Boeing on the defense space, right? They did a deal with Boeing. It was positive for Boeing, positive for Palantir. But like, just look at the price action of this thing. Everything in that space got hit yesterday, apart from Palantir. And I give up. I'm not trading this thing. So it's just not worth the fight. There's other things to do.
Yeah.
It's not worth it. I can't be bothered. And listen, I don't agree with the valuation. I don't agree with a company being given a premium when other companies are not like this. But I also respect price action, and I've got no interest in fighting it anymore. So.
There's still an argument to be made for, on the options side, selling calls and selling puts, because we saw it dropped to a more normalized level around 155. Now, you're happy to buy it at 155, so you're happy to sell puts, and especially when the vol's that big. So that's one thing, is that you're selling a 155, you're selling a 200, let's say, or even Bank of America, you want to sell the 210s, you probably get $5 for it.
Yep, I mean, your option strategies are always nicely hedged and clever, and a good way of just chipping away and making money. Couldn't agree more.
That's not what you say off air. That's
no. I mean, personally, I just find it quite complicated and a bit messy. But you're very good at doing it, and you also make money out of it. So that's great. But just in terms of naked positioning on this company, I don't.
Dangerous.
I just listen. You've got to. It doesn't matter whether I think I'm right or wrong, or whether I am right or wrong. The market's telling you a very different thing, and I'm not fighting it anymore. Goodbye. Yeah. It's off my screen.
Right. Just beware the crash.
Yeah, no, listen, if it crashes, great, but I've got QQQ short. I'm happy with it. It's a lot less stressful.
Let's go on to plug, because this thing...
Now, let's talk about something that is working perfectly.
Suddenly took off. What have you done?
Well, this
a rocket ship.
I mean, listen. I dare I say this is just a home run. This is exactly what I thought was going to happen, right?
Well,
this is exactly what I thought was going to happen, and for exactly the same reasons, and that's a nice feeling. Unlike Palantir.
Boise's saying thank you. He sold at 280 yesterday.
Yeah, well, that's nice. Well done. That's a 3 handle would have been nice, but that sounds like you made a nice trade there.
Do better, Boise.
Yeah, it's shocking trading, mate. So, I mean, listen, this is undergoing a short squeeze, and it's for good reason. And what I find most interesting about this, and this is, again, similar to Micron and Marvell, is that it's all about, yes, okay, there's a lot of things going on with this company. First of all, the heavily shorted small caps are squeezing, particularly in areas like LiDAR and alternative energy and all these different places. But the story yesterday, which really got this going, was that these guys are now being looked at because they had a significant increase in one of their production facilities of hydrogen fuel. And the market suddenly thought, hang on a sec, we're desperate for power in this world. They're just ramping nuclear, they're ramping coal, they're ramping everything they can possibly get their hands on. Why not hydrogen? So, and that makes total sense, of course. And we've got 33% short interest in this company, so it's not going to take much. But bearing in mind, so I've been trading in and out of this thing like a maniac because that's what I do. And I missed, to be honest with you, I probably made about 55% out of it instead of 155%. Nonetheless, I sold yesterday. I bought it when it was up 6% on the open, sold it when it was up 20%, then waited and started buying it again, and it was up when it was up 5, gently. It'll be down again today. Listen, it needs to come back. It was up 10 days in a row. Yeah. It's a volatile, crazy short squeeze, but my view is the short squeeze has got further to go, and the market's probably going to cotton on a little bit more to the power angle to this because it makes sense.
So the market's starting to branch out. It's starting to look at memory. It's starting to look at power, and you're seeing fully valued. Even Jerome Powell was telling you that stocks are expensive. Of the Nvidias, of the are we at peak positive news flow?
Yeah, I mean, listen, we're in a very, very exuberant, scary market in many departments. But you've got to keep. But I do think that it's morphing and it's rolling, and the focus has all been on the hyperscalers, the obvious AI capex beneficiaries, They've been crowded names, which are no longer leading the market. And the small caps have been given a green light by the rate cuts and the macro. So that and so there's a lot of short squeezing going on and there's a lot of in energy and the more value orientated stuff, but also the junk part of it. And I think that's got legs. I think the market can slowly correct in the obvious stuff, whilst this stuff outperforms. It's going to be volatile, but I can't see a market crash anywhere in the near term unless we have a catalyst for it.
Yeah.
And at the moment, we don't have one. So all I can see is a rolling over of QQQ, a much needed correction, whilst a lot of this stuff continues. Yesterday was a great example. The Russell was up 1.5% at one point when the QQQ was down 70 basis points.
Yeah.
Right, and that's rational. That's good. That's the way it should be right now. It's a nice day to see that, quite frankly.
Yeah, it's just whether it continues on.
Yeah, I mean, listen, it's the Hail Mary trade, long RTY versus short Nasdaq, right? Everyone wants to do that trade.
Yeah.
But does it ever work? Once in a blue moon. So I've got it on at the moment.
Like a long FTSE.
It's a crazy trade because it sounds so awesome, but it never ever worked.
Yeah. Soundhound has worked.
Soundhound is great. Yep.
Shrimp Fred asking, where are we on Soundhound now?
Great. Well, hopefully you got in when I started talking about this around the 10 level. Casual 70%. This is back on the agenda for a number of reasons. The earnings report obviously started it all with 240% revenue growth and only 1 penny shy of a profit. And then they've done about 3 or 4 deals. Yesterday they did one with Red Lobster. You can laugh all you want about it, but these guys are really penetrating healthcare systems, restaurants, in-car systems. It makes sense.
Just remind everybody what they do then.
So these guys are the oldest and most established AI voice assistants. So which makes sense. Like in a world of like driving is their obvious business, right? Because when you're driving, you need the highest quality AI-assisted voice you can have. Is obviously makes total logical sense. Ordering food, dealing with health hospitals. There's a whole bunch of different applications. They've got loads of different new contracts going on. And they're growing ridiculously fast. I mean, 240% revenue growth, but they need to keep the bottom line going, which they are. From a technical perspective, this has now become a technical story as well, right? The chart looks awesome. It looks like it's going straight back to the highs of 24 to me. I actually sold my long because I'm a hyperactive ADHD trader, but I will be buying it back.
You have taken money in quite a lot of things, haven't you?
Yeah. I'm very wary of the upside and much more excited. I'm basically trading intraday at the moment. I'm cutting longs very quickly, and I'm just got my QQQ short. I've stopped.
There he is.
Stopped shorting all single stocks because I can't be bothered. I'm just got a large QQQ short.
That's what this kind of price action does to people. It drives you crazy.
Yeah, until
so single stock shorts get squeezed out.
Yeah.
And that's where we are. The majority of shorts have got to be squeezed by now.
Yeah, I mean, there's plenty, and there's more to come. But it's like some are only just starting to get squeezed. But yes, it's a deeply frustrating market. But also, there's loads of money to be made. I've made 33% in the book that I run.
And it's almost too easy.
Well, this is the point. It's become the volatility is so low, and the same trades are working.
Yeah.
And that's when it starts to get real easy to make money, and that's when it starts. But as a professional, you start going, alarm bells start going off. But that's okay. I've got my QQQ short.
You know what happens next?
Yeah, but the beauty of my short is that it's not going anywhere, right?
Yeah.
It's just massive. It's sitting there. If the market sells off, I'll make money.
Yeah.
I don't care. In the meantime, I'm just dicking around in these small caps. I don't care. It's quite fun. And buying things like Orsted and selling it on the rights issue and stuff, just silly stuff like that.
Do you know what? We haven't covered Orsted much. It's really interesting. I wonder if the initial move by Trump was because they wouldn't give him Greenland. So that he decided to attack because Danish government, obviously one of the biggest holders.
Yeah, maybe. I mean, his entire attitude towards this whole space is pretty negative. But the judge blocked it, of course, right? So you saw that.
Yeah. So what?
So for now, and they're 80% complete on this project in Connecticut, which means that there's a very good chance that the judge has blocked it now. So whilst the Trump administration appeals that, in the meantime, they're just going to crack on doing their work. So bearing in mind, this stock...
Get the chart up, please, guys.
Orsted, yeah. This stock was being priced as if the US business was a zero. Plus, they did a massive diluting rights issue, which was actually quite well received. I mean, the market traded quite well on the back of that, and the rights have. So it's all actually gone quite well based on the fact that it was an Armageddon situation about 2 weeks ago. Right? They've done a massive cap raise. It's huge dilution.
So this was this last move down, wasn't it? That was the rights issue.
Yeah. So hang on. What's this? What?
So this is the Danish line.
Is that? Are you looking at that on CMC Markets? No.
Because it's so bad.
It's so good.
Yeah.
Look at that gap. Wow.
Yeah.
She's a big one.
And that's so it just shows you that 8% move yesterday on the back of the judge arguing in their favour is nothing, is it? Absolutely nothing.
No, listen, the stock didn't move. The stock was up 14% and it faded all day back and closed the day up 3.5%. So it's still, but then it's got support this morning. Listen, my view on Orsted is that it's a pile of steaming you-know-what. But
turbines.
But it's interesting because they're not going out of business. If you mark okay, look at what the analysts have done. There's been a whole bunch of hedge funds that have piled into this, by the way, in size.
Right.
Right. The obvious upside is that there's a walking back of the US thing, right? And that means stock's up 50%.
Yeah.
Let's assume that does not happen, and let's assume that US business is zero, and you can still get a valuation of this company about 20-30% higher than where it is.
Really?
Yeah.
Where else are they?
My analysts have looked at it. I've looked at other analysts. It's not a zero. It's being trading like it's a zero, but it's not a zero.
Okay.
And I just love situations like this where the market gets so aggressively bearish on something, and you just work out, hang on a sec, is this going out of business or is it not going out of business? They're not going out of business. And the judge blocking is actually quite interesting because it means that at least they can complete that project in Connecticut. And maybe who knows? Who knows? We've seen the Trump administration do circles on this before. They did it with Plug.
Well,
they blocked
with everything.
They did it, exactly. So who knows what the next bit of news is going to be? Yeah. All I know is that if it's the worst case news, it still can go higher.
Hello, Twitter friends. Welcome back. And we have the infallible Bill Blaine with us, all the way from Hamble. Bill, how are you?
Tickety-boo, tickety-boo. I'm always tickety-boo. Unfortunately, it's a bit grey this morning. I was hoping for another sunny day.
We can't have this everlasting summer forever. I mean, it's been beautiful, hasn't it? It's hard to beat when Britain is this beautiful.
I'll tell you why I like sunny days, because I've noticed over the summer that there is an inverse correlation between how sunny it is and how much work I'm doing. And this week has really been one of the busiest weeks that I've seen in months since the beginning of the summer. And it's been beautiful weather. Today I'm actually going to have something of a slow day. And guess what? The skies are grey. Now, I suppose that's a good thing, that it has been such a busy week. There are so many things now starting to move into action. We're seeing a lot of investment firms starting to think about, really, where are we? And I think they're beginning to connect many of the dots. But at the same time, it's a shame if you find yourself hankering for a quiet day. I just realised my glasses are squint. How did that happen? I must have sat on them.
Again.
Yes, again. I could see a visit to Cutler and Gross next week.
Loads of people chiming in and saying, welcome back, Bill. Kukumba saying, hey, Bill. Also, questions as well. A good one from Pelican, whose real name is actually Mo. Thoughts on slight leg down S&P 500? There was a lot of chatter on the Discord last night. Is this it? Is this the buy the dip moment? Or, as it turned out, it all kind of moderated out in the end. But Pelican saying, I'm not bearish as up overall in September. What is your view? Because I know, Rich is very much in the camp where he's, put his investments, turned it into cash. I don't know which bit, but he said he's now awaiting this correction. We've got Rick Bensignor as well, of Bensignor Investment Strategies, all the way from New York. And he's saying that, we're weeks away from a first swift decline, 5 to 11% decline since the April low. Where do you sit on this? Is the music and the party going to be turned down slowly, or are we going to see a power cut?
I think you're right. So you and I have talked about this number of things. I am very much in the camp that the market is due a correction. And when that correction occurs, I'm going to pull on and lace up my buying boots very tightly, because there will be opportunities. But I think it's going to instill a sense of reality back into markets, because at the moment, I think markets are behind the knowledge curve. They're still overly complacent and overly euphoric. Now, one of the things I was writing about earlier this week in Blaine's Morning Porridge, which I assume you're all reading, was this time of the year, I start to suffer from a terrible phobia called octophobia. Now, octophobia, the irrational fear of October, is because the very first market crisis, or the first big market crisis I experienced, was 1987 and the Black Monday crash. Now, that was actually triggered by trading systems, and then new automated trading systems overreacted some of the signals in the market. But the market absolutely whapped, and everyone was running for the exits at the same time. And that created the crisis. Now, funnily enough, the market recovered quite quickly. And the economic outlook at the time was very much for rising inflation and rising interest rates, because economies were very well overheated. So it wasn't surprising to see that kind of correction. This time we've got something else. We've got complete uncertainty in the market. I can read as many market reports telling me that recession is not going to happen as I can read telling me that it's nailed on. I can also see lots of people telling me this is the end of the dollar era, as they're telling me that it's not. I can look at the politics and I can shake my head at what I saw at the United Nations this week, but I can also look at the dither in the UK as well. So there's lots of things that can confuse and confound markets. But I think the real thing is going to be just looking at some of the stories that are out there. Now, AI, we all know, is a bubble, but it's one that people are still piling into because they see tremendous upside. Now, there are people saying that we will see 90% of the smaller startups that are parasites on the AI narrative collapse. But the trick is to buy the big ones. There are others saying that the hyperscalers are just spending far too much money. And this is definitely something I'm going to be writing about next week. I spent part of this week talking to people who are looking at the difference between how much it costs to launch a large language model as opposed to using something that is based on a much smaller set of data, but very much more focused. So this is something we need to talk about next week. What are the costs? What are the infrastructure costs of AI? Now, you look back at history, and the world is littered with wonderful stories of AI, of bubbles bursting.
Oh, the tulips. Oh,
yeah. Well,
yeah.
Yesterday's morning porridge was about exactly that.
Oh, really?
Tulips.
Oh,
yeah. Well,
I didn't know that.
I use tulips to look. I have great fun writing the morning porridge about which photo am I going to include with it. So I was writing about don't overestimate the chance of a crash in the UK gilts market. I would be far more worried about US treasuries than I am about gilts at the moment. And so I illustrated that with a picture of a train wreck.
Let's show this picture for our friends.
The day before, or the day after, I think I used tulips to illustrate what I think is a very interesting thing about markets, which markets tend to follow the money. And nothing generates flows into a narrative than money piling into that. That's what triggers FOMO. There you go, the morning porridge. Read that, and I don't need to appear on your screens. although I have started doing it as a YouTube, and it would be great if everyone would look me up on YouTube and like the thing. And the only reason I'm doing it is because my kids were telling me I had to go and do it, so I have. Yeah. So some of the other things that are going on in the market that add to this sort of concern that I have that we're heading towards an outbreak of common sense would include the number of defaults that we're starting to see in the US. Now, one of the things I learned back in my banking career when I was working for a well-known British bank, the home for Scottish bank clerks, as we knew it.
Yeah.
Everyone else called it HSBC. And when we were taking over a US subprime lender, we did some research to find out what it is the last thing that US consumers stop paying when they run into financial difficulties. And we all assumed it would be their house or their car.
I was going to go with mortgage first.
Right, mortgage. We assumed mortgage first, and then we thought it would be their car because we knew everyone in the States needs a car to work. And it turned out cars were the second last thing they stopped paying. The very most important thing that they kept paying was their subscription to the sports channel.
No.
Yeah,
well, I can see that because the Americans love their sport.
They do indeed. But the second most important thing was their car, because you cannot function in the States without a car. So it's kind of interesting that we're seeing defaults in US auto loans, mainly to subprime borrowers.
So where do we get the data on the defaults to payment of sports?
It is all there. Someone can do a quick internet. Oh, the data on sports, that was proprietary for HSBC at the time. But the data on auto loans is all there to be seen. And we've seen one of the auto loan companies go bust this week. There's another one that's looking to default as well. They're currently in bankruptcy negotiations. And that's a clear signal to the market that, oh yeah, people are under stress. But it's also a signal to the credit market. Now, credit, as I keep telling you, Andrew, in bonds there is truth. And in the credit market, the credit part of the bond market, we are seeing the tightest ever spreads that we've seen throughout my 40-year career in bonds. And that just, that surprises me, because we've got all kinds of problems in the US economy. We don't know what the effect of tariffs is going to be on inflation or on consumer demand or on orders and how that's going to affect. But yet we're saying to ourselves that US companies are in better shape than they've ever been. And that's because interest rates are going to fall under Trump, and we're going to see a massive explosion in earnings. Now, if that's not happening, and the reality is that companies are under more and more stress because consumers are short of money to go out and consume, then that picture will start to reflect in the equity market. And that's another reason I'd be slightly concerned about how euphoric the markets are. Now, going back to octophobia, irrational October.
Have you made up this word, or is it one that's already in mainstream?
Make up a word? Well, yeah.
Never.
Okay, I'll accept that. Octophobia. I am.
Cucumber said Rectober is another one.
Well, it may end up being a Rectober, but what I think it's going to be is just a bit of rationalization and people waking up to what the reality is. But there's lots of other things going on in markets just now. And one of the things I'd love to talk about is railways.
Are you one of those people that has a little railway miniature thing that delivers your coffee to you when you flip a switch? Are you one of those?
Right. Tomorrow, September 27th, is the 200th anniversary of the first ever railway. And that was the Stockton-Darlington line in 1825. And George Stephenson built a railway engine, locomotion number 1, and off it went. And it's 200 years ago tomorrow. Now, the birth of the railways is actually quite an interesting tale, because it spawned railway mania. Now, I would argue that the age of steam, that's railways and steamships, that is the thing that made the world much, much smaller. Over 600 people jumped on that train the first day. They were piled into coal trucks, and there was one passenger carriage, which was actually called Experiment, because nobody thought that people would want to travel. But you actually think about it, these 600 people, most of them had never been more than 6 miles away from the place they were born. And suddenly, within 20 years, they were able to get to London in 4 or 5 hours.
Let's try and get this picture up for everyone. Look at that. Look at that. It looks a bit like
there you go.
peak hour traveling from London Bridge on a train.
No,
everyone stood up.
That's nonsense. That's nonsense. That looks far more comfortable than peak hour on the Jubilee line. But the thing is that over the next over the entire 19th century, we saw a succession of railway booms around the world, very much like the kind of booms we've seen in technology. And remember, steam technology was the technology frontier of its day, just as AI is today. And what's been really interesting to me as a railway fan, I mean, if you showed me a picture of a steam engine, I'll probably tell you who designed it and what its name is, just because I've got that boyhood fascination. And yes, I did have a train set up in my attic until my wife insisted we redid the house and turned the attic room into a reception room. So,
now, Bill,
I'm
going to stop you going full steam ahead there, because we
see what you did
full
there.
steam ahead. Because we have a ton of questions for you. R6Anna asking, what is Bill's view on staying with long-term holdings even in pullbacks? That's a really good question.
Okay, right. We go back to one of my fundamentals on markets, which is the difference between trading,
and
which
investing.
is where you're following the sentiment of the market, and investing, where you're actually looking at ideas and concepts that are going to work. And if you pick the right idea, sure enough, they're going to work. So if you had bought Apple back in 1992 and you were still holding it today, your returns are going to be massive. But had you bought WeWork in 2020, you would be bust. So it's a question of looking at the fundamentals of the business, working out, is it ever going to make any money, and what its future is going to be like. And then, you make these decisions based on what the business plan are, what the outlook for the market. You use all the common sense you can get into the market. And I do think that the market sometimes loses sight of that. There was a fantastic American investor back in the 1920s. He had a brilliant book, and I think it was called Where Are All the Customers' Yachts? A guy called Ben Graham. And he was the one that said the market is, in the short term, the market is a voting machine, but in the long term, it is a weighing machine. So if you do the Warren Buffett thing and hold stocks for the long term and pick the right ones in the first place, you will tend to do well. Because even if we get a correction in the next month, or even a market crash, I guarantee you the stock market will come back and make new higher highs within a very much shorter time than the doomsters expect.
There's another saying is, all these people came to me, and what should we do? We've got lockdown 1 looming, and then when it happened, everyone's like, what do we do? Do we just sell our shares now? The end of the world's nigh. It's like, well, no, if end of the world is nigh, you go long anyway. And actually, we always know that no matter what, usually the market comes back, unless you've bought some crazy, speculative, stock that is not liquid.
There's a couple of key mantras, and these are Blaine's famous market mantras. I must write them up one day. But number one,
put it on your bathroom wall.
I will. It's going to get written up for next week. Number one mantra is the market has one objective and one objective only, and that is to inflict the maximum amount of pain on the maximum amount of participants. But number two mantra is things are never as bad as we fear, although they are seldom as good as we hope.
And another question from Derek, a very good one too. What will Bill buy when the correction comes? What are you going to buy when we get the avocado moment?
Right, okay. You are Derek is not the first person to ask that. On the number of clients were asking that, and some actually asked it up on the website. What would I buy? And that's a tough one, because I'm looking at some of the stocks that I've admired over the long term. I mentioned Apple there, but I kind of think Apple's kind of running into a bit of a wall just now, just because, a tech company that isn't innovating for anything and seems to be missing the AI boat is just not floating it for me at the moment. There are stocks that are massively undervalued that should be doing better. And these are the things where you've seen some names, like if we take the auto sector, everyone is going to require cars. That's not going to finish. But I certainly don't think that Tesla is going to remain part of that equation. Now, the reason I think that is Tesla's kind of lost sight, and I go back again to history there. In 1903, the Wright brothers were the first people to fly. They innovated flying just in the same way that Elon Musk innovated electric vehicles. But within 10 years, Wright brothers were no longer selling any of their aircraft. Other people had come in and developed better ones with better engines and better flight controls. And by the time of the First World War, Wright brothers were only making engines and were out of the business. I think the same thing is going to happen to Tesla. But other people are going to...
There are a lot of hardcore Tesla fans listening in here.
Disagree. Yeah, people will tell me Elon Musk is the greatest innovator, inventor. I mean, I listened to a podcast with Kathy Wood this week, and that's what she was saying. But I'm looking at Tesla and thinking, that ain't a stair. Maybe XAI will become something else, and maybe SpaceX is going to get there and make a space rocket that actually works and gets them to the moon. Who knows? But I reckon in the auto sector, everyone else is now perfecting better technologies. And I also think Tesla is going to lose the robotaxi war because, frankly, their tech is not as good as Waymo's. That's the one that's going to work. So you've got to look at who the eventual winners. And when you see that profitable car companies like Toyota and Merck are making proper money and selling proper cars and are now introducing cars that are better, that's when you have to think about it. And you and I both know how good the new Chinese cars are going to be. And I was reading about, I think, is it Chery, the Chinese automaker, has just ordered 12 brand new car transporters. These are massive ships that are designed solely for exporting ships across to Europe.
Mind you, though, Warren Buffett has, according to filings, exited BYD, which is also very interesting. BYD, I don't know whether you've been to any of its showrooms here in the UK and taken a look at the cars, the price points, and actually they're becoming very attractive. You know, we had this huge discussion amongst the analysts yesterday. Would you trade, for example, you know, from a Porsche to a BYD or like a GLE to be? No, you wouldn't. But would you trade to a BYD if you were driving a Ford? Yeah.
Look, I'm in exactly this spot, or was in this spot just recently. My Range Rover recently died, which was a real pain in the butt, to be honest, because the engine seized. So I went to look at new Range Rover. As we all know, Range Rover's in really serious trouble just now because of this cyber attack.
Oh boy, do I know it?
Couldn't even get a test drive arranged. Needed to get a new car. I went and looked at a whole bunch of things thinking, yeah, it's time I looked at something else. And to be honest, I was really kind of upset that 3 months after the warranty expired on my car, it was worthless. And I know a lot of people have problems with their Range Rovers just now. So I went and looked at other things. And I think it was after a conversation with you about Polestar. I went to look at the local Chinese one. And this was a Moda, which is part of Chery. And their Range Rover proxy or analog, whatever you want to call it, I took it for a drive. And I was thinking, this is actually okay. It was actually quite pokey. Now, it wasn't the prettiest car on the road. And it had these big fake tailpipes at the back. But it actually drove really well. It was quite pokey. I quite enjoyed it. And I looked at it, and I think the all-in cost with everything like a panoramic roof and everything else was 44,000 compared to 144,000 for the Range Rover.
Brand new,
now,
right?
I ended up not going for the Chinese car. I decided, let's wait and see how they go.
So there's
But,
one other thing that I get asked a lot here, and it's to do with the fact that, you know, are we looking at are we at the end of this rally? Are we in the middle end? Or are we, you know, going to see quite a few more years and certainly months of this? Now,
Wow.
Andrew McKilvey asked a really good question. Yeah, so Andrew McKilvey wants me to put this to Chris Beecham to critique, but I also would like your thoughts, Bill, on this. I asked Andrew why he thinks that perhaps the party might go on for another 2 years. So his reasoning is, so Powell's time finishes in 2026, cheap money kicks in, all asset prices, as we know, float up, continue to rise, boom times throughout 2026 and 2027. But then inflation calls time on the party and money gets more expensive again, stocks fall. It could be longer than 2 years, he says, depending on the extent of cheap money. Either way, the next US election cycle will have an impact. What do you think?
Okay, you've just asked the ultimate question, which is what's the outlook for the future? Do we see this kind of scenario for markets to continue rising? So one thing that could happen is this point about rates being forced lower by Trump taking over the Federal Reserve. If that happens, you will see, as has happened since the cut 2 weeks ago, the Fed cut rates, but bond yields have risen. Now, the way that you get bond yields down, which is the actual rate that matters for the economy, is you'll need to start manipulating bond rates, and you do that through quantitative easing. Now, the last time we saw quantitative easing, 2010, that's when it was invented, in fact. Quantitative easing caused interest rates to fall, and we saw zero interest rates. And the thinking there was that if you have zero interest rates, corporates will borrow lots of money to invest, and that will cause a boom in the economy. Well, we didn't see any boom in the economy. The economy continued to flatline, but what we saw was all that money being pumped into financial assets. So yes, that's one upside. If Trump takes over the Federal Reserve and Scott Bessent goes for quantitative easing, all that money will flow into the stock markets, and that creates massive income inequality, which is exactly the reason that Trump got elected, which was to make sure that all the forgotten people, the MAGA supporters, were sharing in the upside, because they all felt so left behind watching how rich people who own stocks were getting. So that's that's going to be an issue, certainly by the next US election, if it happens. But we're also at a very different stage in the global economy. We are seeing a massive geopolitical shift going on, and that's between Asia and North America. Now, at the moment, the US is kind of guaranteeing economic problems by the way it has done the tariff negotiations, basically bullying Europe and others into agreements with them. It's very likely that global trade is going to shift completely in the next 5 to 10 years. We're seeing the emergence of the most important buyer class in the planet is now the growing middle classes of Southeast Asia. We're not just talking about China, we're talking about India, China, Korea, the Cambodias, the Thailands, Malaysias, all these nations. That's where global wealth is going to be concentrated. So that's where you want to trade with at a time when America is closing the doors. So I don't think it's a given that we're just going to see this rally continue. I think we're going to see new focuses and new trade lines, which will go through the Middle East, which is why the Middle East is going to be so important. We're at a time of enormous change, so it's very difficult to predict. If we see quantitative easing, then I think markets will do what they did last time, which is in the short term, they'll rise because sentiment will see that. But long term, the distortions that they cause will fundamentally wreck the US economy. And I think other economies now see that and will make sure they don't get caught up in it.
I
There
definitely
you
remember
go.
those
Too
times, Bill,
important.
because I was at Bloomberg and everyone was taken into everyone, whether you were, a stocks editor, whether you were working on the commodities desk, everyone was rounded up and put into 2-day intensive, what is QE, why we care how the markets react, and that was quite something else. No one was allowed even to take long breaks. It was a real amazing time because it was in a time when the city still believed in proper training, and Paul Addison was the head of learning at Bloomberg. Call out to him. I hope he's having a lovely retirement somewhere in Asia. Taking a look at one other question from Monkey Man on the chat here. If you bring up the chat for us, people in the gallery, we've got Monkey Man saying, next 12 months, US will print money and markets will pump. Crypto and tech will fly. What do you think, Bill?
Okay, I have never been a crypto fan because I'm simply too skeptical of it. I look at crypto's early stage, and I've done a lot of digging into this, and it's a libertarian philosophy that absolutely fits with Project 2025. So yeah, you can see why there is such a groundswell of support for crypto, but I still ask the obvious question: what does it do that's better than stuff we don't already have? Now, yeah, and then people will say, oh, but blockchain. Yeah, blockchain is a solution in search of a problem, and maybe we'll eventually find something to do with it. I think that the whole crypto rally over the last 15 years, since it was invented in 2010, is really part of this speculative thing that went on with the easy money that was pumped into markets during the QE zero interest rate era. Now, we know that if you pump money into a system, then people are going to look for ways to actually employ it. And if you can say to people that this is new money and people believe you and they start pumping money in and then more money follows, well, money generates its own momentum, especially if you have a really strong narrative that is telling everyone that they're going to get really, really rich. And if you think back to the days of the first crypto and the second crypto and the third crypto rally, all followed by massive crashes, they were each the same way. They were pump and pump with stay poor, bro, or invest now and get mega wealthy. And then, of course, the thing sells up. Now, it's interesting just now, we are seeing something of a small sell-off in crypto. And I'm told that the real reason for that is some of the retail whales who have done exceptionally well over the last couple of years are now taking their profits to the top of the market. And it's probably not even that much because it is a very small and a liquid market. But all it takes for them is to start to exit. People see that and they start to exit. Money generates money. And if you get a flow of money in or out, it generates a disproportionate reaction. And that's what's going on just now. So I remain unconvinced in crypto. I think, and it's far too small a market. If you think about it, it's only 21 million bitcoins. And yes, I know they're split into satoshis, which are a billionth of a bitcoin or whatever they are. But the fact is that, of the original Bitcoin, all the one that Sakamoto himself owns, none of them have ever traded. Most of the early ones never ever traded. They're probably lost in a landfill somewhere. And of the ones that are now held by these Bitcoin treasury companies, oh, by the way, that's going to be an enormous blow up when it happens. So, the story of Bitcoin is the story of speculation, FOMO, and false narratives.
So Bill, I'm just going to squeeze this in there because this is I was reading there when Monkey asked the question because Bill hates crypto, so I thought, this will trigger him. Monkey Man is now asking you, Bill, so why are governments buying crypto then?
Governments buying crypto is Donald Trump buying crypto because Donald Trump has made an absolute mint out of being a crypto supporter. Look how much money Liberty Global is making from its meme coin, or Donald Trump personally and Melania have made from their meme coin, and look at how much they hope to make out stable coins. Now, the stable coins are interesting, but they are not crypto and they are not money. They are simply a token that allows you to do a fast transaction. I think people think that they're some kind of crypto magic. They're not. They're something very different. And, the US has declared it's going to be crypto friendly. What does that actually mean? If Bitcoin replaces treasuries as the libertarian wing would like it to do, and you dispense with all fiat currencies, how will countries actually solve their financial and fiscal problems? Well, they won't be able to. It makes no sense for governments to go all in on crypto and give up their financial sovereignty, their monetary sovereignty. It just doesn't make any sense. But then I struggle. I'm told that I suffer terrible Trump derangement syndrome in that I can't see the underlying genius of his approach to crypto. Call me a skeptic, call me old-fashioned, call me stupid. Maybe I am, but I'm going to stick to my hostility on crypto. That said, I do trade it. When I can see that people are awfully excited, I'll buy it. And when I can see that they're losing faith, I'm going to sell it. I'll tell you what, at the moment, I'm short.
And on that note, we thank you so much for your precious time, Bill. We're going to go to the Art of Investing episode 11 after this. Keyword there is investing, not trading. So this is the Art of Investing with Rich and, of course, Puppy and CJ as well. Everyone have a great weekend from Ange and Bill here. Whatever you're doing, may it be profitable. Thanks, Bill.
And have a great weekend. Cheers. All the best.
For inflation, they're still 3% in a year and a half's time.
No, they're not.
We'll have a look at that.
This reminds me, the bulls sing the loudest at the top of the market.
And the bears squeal the loudest as it goes higher. Now, we should have looked more into what we had. That's our bad.
The chairman's bad.
It was my stock.
It was your stock. And you didn't even know what it was. But better to be lucky.
Then good.
So I get taken into the room with the head of risk.
Naughty boy.
Naughty boy. They say, why the hell were you long $500 million of futures last night?
What's known in the trade as squeaky bum time.
It was a horrible feeling. Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. Welcome to episode 11 of The Art of Investing, the Monetary Policy Special. Now, interest rates aren't just what you receive on your savings, pay on your credit cards, or give you stress about your mortgage refinancing. Today, we're going to break down everything you need to know about the policy decisions, the language that's used, and also how it affects the valuation of every single asset out there. Most importantly, how is that going to play into our portfolio changes today? But first, as always, the Spice Market Update.
Thank you very much, Rich, and welcome back. So as Rich says, this is a week where central banks have taken center stage, and that's helped equity markets push the high. And we'll go into a bit more detail about that later on. But we've had new all-time highs in most of the US markets, and even the Russell managed to hit a year-to-date high last night. After the FOMC meeting. But Asia doing very well. Gold and silver also popped up to new highs. So that's all very positive as we have a lot of exposure for our portfolio in that. The laggards were in places like Europe, Germany, France, and of course the UK, unfortunately. As we talked before, we've had some bad news in the UK on inflation. There's a Bank of England meeting tomorrow. We were hoping if the inflation data had been good, that would give them an excuse to cut interest rates. But it wasn't. The inflation data was the CPI, the Consumer Price Index, rose to 3.8%, which is broadly in line with expectations, but didn't give them any sort of scope to be able to cut rates tomorrow.
And that reminds me, we're going to be getting a Bank of England decision as we're on air finishing this episode, aren't we?
We are indeed.
I think they're waiting for us. But they will get it a day late if they do that.
Very true.
On a more positive note, the US CPI, the consumer price inflation, was actually a little bit better than expected last week. And as we'll come on to later, you'll see that that's helped the Federal Reserve cut interest rates. The economy side of the US, apart from employment, is actually doing pretty well. They had really strong retail sales. So people are still spending despite worrying about their jobs, etc., which is a good sign for stock markets, I would tell you.
Or is it an addiction over there?
It takes a lot for retail sales to go negative. Even in recessions, retail sales, funny enough, rarely go negative.
I heard a really interesting stat this week that 10% of the population now is accountable for 50% of consumer spending in the US. It used to be a third, and now it's up to 50%. So that top 10% probably aren't worried about losing their jobs.
No, exactly. That's helped at sort of the feel-good factor for equities and earnings. The US and China are in trade talks still, and tomorrow President Xi and Trump are meeting to discuss their trade deals, and hopefully they'll sign an agreement that takes things positively forward. On the side, for those of you like TikTok, it's expected that Trump is going to allow TikTok to continue to operate in America.
Sorry, Spicy, what I know is Tic Tacs.
But there was worries that was going to be banned, and obviously that would have hurt companies like Oracle, who do all the computer sort of power for TikTok in America. But probably some of the biggest moves this week have come from Elon Musk, who clearly had his nose put out of joint by Larry Ellison having become the richest man in the world, albeit very briefly when Oracle went up 40% last week, because he went out and bought $1 billion worth of shares in Tesla, as you do. And the Tesla share price has gone up 30% as a result in the following days.
Amazing, that is.
It's amazing,
Absolutely amazing move.
Yeah, so he's once again the richest man in the world. Also on a positive front, in the Mag 7, the Magnificent Seven, Alphabet, or Google as we know it, joined the $3 trillion market capitalization club. So there's now only been 4 companies that have ever made that sort of had that accolade. Apple was the first ever. Now it's Nvidia, Apple, Microsoft, and of course Google has just joined them, Alphabet. Cash on the sidelines, we've talked about this before. We had an update on that figure this week, and it's up to $7.5 trillion just sitting on the sidelines in money market funds in the United States.
It's because I sold some of my stocks.
And you put it in cash. Oh, you grizzly bear.
The biggest risk position you own, therefore, is your cash.
So you keep on telling me, but I sleep very well at night.
It's a bit of a technical thing. Trump put forward what could be seen as quite a good idea, actually, for companies. He's suggesting that they start reporting their earnings every 6 months now instead of every 3 months. That's not come into force yet, but it means that it should reduce the volatility around the earnings season and reduce costs of companies, because every time you have to report numbers to the stock market or to investors, that has to be audited, and that costs you a lot of money to do it. So he's suggesting in America you do that every 6 months rather than every 3 months. In the UK, we do it every 6 months. That's the minimum you have to do. That would also sort of help in terms of like less admin, etc. But it would also reduce investor news flow, which I don't think would necessarily be a good thing. That would be the negative, that you don't get as much news flow, up-to-date news flow on companies.
Because we tend to get trading statements to replace that, don't we, in the UK? I wonder if they'll move to that kind of model potentially.
I would think they would do, yeah.
The interesting thing, I suppose, is, I mean, I'm supportive of it. I think it would save quite a lot. And I don't really see quarterly adding too much, but it would make it more difficult for them to play the games they play quite so easily in setting expectations low and moving them up 4 times a year. There would now be more time between those things. I suppose more uncertainty being created in there. But I think it's a good move. I don't think it's a bad move at all.
Anything that reduces the burden on companies has to be good.
I agree.
Then they can concentrate on running the business. So as I mentioned, this has been a big week for central banks. Yesterday, the Bank of Canada cut interest rates earlier this week. The Bank of England report today, as we're recording at the end of this podcast we're recording. The Bank of Japan report tomorrow. But the big one was the Federal Reserve, which sat last night, which was Wednesday night on this week, and they cut interest rates by 0.25%, a 0.25%, or as we say in the city, 25 basis points.
Did much pop out to you this week, CJ, outside of the monetary policy decisions?
I thought there were a couple of things. One, the Office of Budget Responsibility in the UK dropped some not too subtle hints that they are going to be cutting their productivity forecast. Now, before everybody switches off saying, what the hell's that got to do with anything? You need to remember that the OBR are the people who advised Rachel Reeves on the size of her financing gap. And so with the budget coming up, with them cutting back their productivity forecasts, that will give her more of a headache than she already had. It doesn't rain, but it pours. Not only has she now got to fill her own black hole created by the policies that she unveiled last budget and the shortfall that's come from there, with growth not really pushing on at all in her expectation. But she's now going to have to cover maybe between another 10 and 20 billion. Now, that means that we're going to have to watch very carefully, even more closely than we probably were going to, what she says in the budget at the end of November. We're going to have a couple of budget specials before that, but there's a little marker for us that things might be a little bit tougher than was originally thought.
Yeah.
The second thing that I think was notable for me this week, and we'll cover it in the portfolio review, is the great performance of our VanEck crypto fund. Once again, a fund that we bought to control our exposure to Bitcoin.
Yeah.
And in fact, Bitcoin's gone down and this thing's gone up by 25% since we bought it. But finally, just on the Federal Reserve meeting, I was quite surprised to a degree that there wasn't really any reaction yesterday. The market closed pretty much unchanged. And that's because there's such a good discounting mechanism of what people were expecting. People were expecting a 25 basis point cut, as Mark was saying, and that's what they got. So now we'll see in the next few days how the market responds to getting what they were expecting.
Rachel Reeves, part of her problem is the growing debt in the country. Part of Trump's problem is the growing debt. We've got to remember that interest rates come into everything. And it's so important. And that might have been what caused the tension between Powell and Trump. These decisions are momentous. I've done some maths, and I think that you guys must have been through 500 interest rate policy meeting decisions between the two of you over the years. And I would love to just garner some of your experience and hear what you think. What does a decision mean when they choose to cut or increase interest rates? How does a consensus get reached at those meetings, Mark?
Well, all of them have committees. The chairman tends to have more power than everyone else, and that's particularly true in America. And I'm sure it's true in the UK, the Bank of England as well.
And of this podcast.
Oh, yes, Mr. Chairman, sir. Sorry, well, forgive me. I mean, you have to understand that all of the central banks have different mandates. Most of them have a inflation target of 2% or stable prices, what they've got to try and achieve. But the Americans are a bit different. The Federal Reserve have to promote maximum sustainable employment. Along with that, they have to try and deliver stable prices or inflation of around 2%. Now, interestingly, there's quite a lot of interpretation because they cut interest rates last night and inflation is running at about 3% in America and their target is 2%. So why would you say they're cutting interest rates even though they're well at 1% above their target? And it's because of this word stable pricing. If inflation is steadily moving in one direction, but not massively, then that seems to be acceptable in the eyes of the central bankers. And that's one of the reasons they cut interest rates yesterday. More importantly, they also have to try and maintain sustainable maximum employment. So when unemployment starts rising, which it has just started to do in America, and the job creation has been much worse than expected, and we talked about payrolls being the guide to how jobs are being created in America, that has come in much worse than expected and was revised down massively by nearly 1 million jobs over the last 12 months. That seems to be where their main focus was last night and why they decided to cut interest rates.
And he even made mention of it in the press conference afterwards. He said, it's not often we get a real tension between our two predominant targets. And at the moment, inflation was our focus for the past few years. Now, the risks to inflation they've dropped a little bit, whereas the risks to the downside for the jobs market has become elevated. So therefore, they've become more in balance and we need to focus on employment, don't we? So did that signal the start of a interest rate cutting cycle, or do you think it was just a one-off?
What tends to catch people's attention and gives a bit of momentum to sort of market moves is when you change direction in interest rates, or you start a new sort of period of cutting interest rates. The last time the Americans cut interest rates was back in December 2024. So, coming up for a year or so ago. And basically, yesterday was the first cut. Now, the markets are anticipating that there'll be another 5 or 6 cuts even between now and the end of next year. In fact, the most probable outcome is for another 5 interest rate cuts, 3 of those to come in the next few months. So you get 1 this month has just gone, 1 next month in October when they next meet, and then 1 in December before the end of the year. So you're going to see interest rates fall pretty steadily now, which is one of the reasons I've been positive on the US markets, particularly because when you're in this period of steadily cutting interest rates, it's a good underpin for the economy and for ultimately share prices.
And just to remind us why lower interest rates give a path towards higher asset values because of the timing factor.
There are 2 ways that works. One is if you're borrowing money as a company and you're paying interest on that debt, which most companies have debt in their balance sheets, then basically your interest charge comes down. Now that gives you spare cash. You can either go and employ more people, or you can give it back to shareholders in the form of dividends or share buybacks or whatever you want to do. And that helps support a share price. The other thing that also helps, obviously, economic growth, because as I say, if you might employ more people with this spare cash, then that's also good. The long-term prices of share prices are driven by what's called the long-term discount rate, or discounted cash flows. So if you add up all the dividends in the future of a company that you're getting, or the earnings per share, and you use an interest rate to discount it back to today's share price, the lower the interest rate, the higher today's share price should be.
You're dividing the future profits by the interest rate. So if the interest rate's lower, it means you get to value it.
Exactly, a higher share price today. And vice versa, of course, when interest rates go up.
Of course, taking a bit of the devil's advocate view on, the events of yesterday, the market went in talking about 6 rate cuts, including the one of yesterday. And the market came out talking about 5 more rate cuts, being the same number. So really one has to ask what's new. And actually nothing is new. Nothing has changed. And so I think that's interesting in the first place. We've not come out discounting another 2 or 3 rate cuts or taken any away. We've actually come in at the same amount.
Actually, there was some insight into the way this may evolve. So Trump managed to appoint a member of the Federal Reserve, a new member, yesterday, called Stephen Morin, right? And Stephen basically looks like he voted for 0.5% interest rate cut rather than 0.25%. Now, he's the only dissenter and the only one going against what the chairman was suggesting. And if you look forward a year, he's guiding in his expectations to interest rates in America being down at 2.75% to 3%, and they're at 4 to 4.25% as of today. If that's a guide to perhaps the way the Federal Reserve will start thinking as more people who are believers in Trump's way of doing things get onto the committee, because remember, the chairman of the Federal Reserve steps down in May. That's the end of his tenure. There'll be a new chairman. He undoubtedly will be more Trump-friendly. If you get more and more people thinking like that, then you could get even bigger interest rate cuts than people think.
Let's not sugarcoat this. This is a guy who is still employed at the White House, who has come in and dissented against the committee all voting for 25 basis points, and has come out with a hugely lower number than anybody else. And we only know this because we get the projections going forward 4 times a year. And if that is sign of things to come, CJ, that more and more of these important people in the committee are appointed by Trump, and the only interview question is, will you do what I say? Where's your Federal Reserve independence?
We're obviously going to have a bit of a agreeably moment on this sort of stuff. First of all, rates of 4 to 4.25.
Yeah.
5 rate cuts takes you to 2.75, 3.
Yeah.
So actually, what he's saying is what the market's pricing. So who cares how many more move? I don't care, because the market's pricing it already, right? Number one. Number two, I'm totally with you. In comes a guy who would love to be the next chairman, who says, how can I impress? I know what I'll do. I'll say I want 0.5%. and off comes 0.5%. And he says he's going to do 0.5%. And now I noticed this morning in the betting odds, he is now favourite to be the next fair chairman. And Chris Waller, who was, because he went half the month before, is now second favourite. So this is just a game of musical chairs. The market's already there. The market's saying that's where we're going to get to in interest rates. Now, I'm going to take the other side. What they said clearly yesterday, Powell said clearly this is an insurance cut. All right. Now, what he's saying by that is, I'm not sure about what's going to happen to inflation. I'm not sure what's happening to unemployment, but the unemployment numbers have definitely turned down a bit. So I'm going to take out a bit of insurance. Right? Insurance doesn't mean to me 5 cuts. I think it's very dangerous for us to sit here and say we've got 5 cuts baked in when I've got a stock market in the States flying higher all the time, massive liquidity, massive inflation. I mean, we talked about bubble. We clearly are in a process of building a bubble. I'm not suggesting we're at that end of that process in any way, shape, or form, but we're clearly in that process. If we look at what's going on in some of the more esoteric asset classes, like the crypto markets and all these digital treasuries, and how much money has gone into these sorts of asset classes, it's not telling me there's any shortage of money out there. Now, normally we cut interest rates when we expect monetary conditions have tightened too much and we want to loosen them. All the signs out there is that money's cheap and plentiful. Inflation is above target.
And rising.
But under control.
And rising. It's now at 3%, and they're cutting rates, 5 more cuts priced in, and still the forecasts, if you look at the Fed's forecast yesterday for inflation, they're still 3% in a year and a half's time.
No, they're not.
We'll have a look at that. we can look at that because that's that's factual, right? Whatever that number is, but there's not falling inflation down to 2%. That is not where the Fed is on its forecasts or where its dots and everything else. So to me, I don't really understand why everyone is so confident about 5. I think there will be obviously some. I'm not disputing there'll be some, but it's, do we think 5? Where do you think they're going to get to? I don't think we're going to get 5, is what I'm trying to say.
CJ, can I correct you there? You're right for their forecast for inflation for the end of this year, 3%. But by the end of 2026, they expect that to fall to 2.6% and then to 2.1% by the end of 2027. Now, the interesting thing is that they've been talking about 2 years forward getting to their target for the last 4 or 5 years, and they've never achieved it. They've always been running ahead of it. And that was a feature of last night's sort of press conference.
I think that's called kicking the can down the road, isn't it? So what happens if we do get to the point of policy mistakes? What are some of the consequences in history when they've done the wrong thing?
Well, I mean, over history, there's been lots of examples of where people have made mistakes, and most of them actually the big ones have been by the Federal Reserve or the European Central Bank. But the Federal Reserve, coming up to the Great Depression, actually basically continued to keep interest rates low and basically let a bubble create and then burst. It was a property bubble. And they basically didn't raise interest rates to control that bubble beforehand. And that led to the Great Depression. In the 1970s, when we had very big inflation numbers, again, the Federal Reserve delayed putting interest rates up and let inflation get out of control. And eventually they had to put interest rates up a lot. Volcker, the Federal Reserve chairman then, had to put interest rates up significantly in the late 80s, which was very damaging. But ultimately solved the problem. But the most recent time was in the early 2000s, as we were running into the great financial crisis. The Federal Reserves again kept interest rates very, very low when they were when there was a housing bubble and property bubble going on, and people were borrowing in huge amounts of money, leveraging up, as it's called, borrowing more money they couldn't afford to pay back. And of course, we know the ultimate consequence of that was the property bubble burst. Lots of financial assets were associated with that, and banks particularly were exposed to the bad debts that came with the fall in property prices and deflation.
So, and this was consequences of obviously we had the dot-com bubble bursting. We had 9/11 and the effects of that on the US economy. So rates were at a low point, I think 2%, for too long. They were kept too low for too long. And that stoked all these problems that were growing throughout 06, 07. By the time they got rates higher, then it was too late. There was too much money in the system. There was too much flowing. What's to say that's not been the problem now? We threw all this cash into the economy to save us from COVID, right? So there's way too much liquidity sloshing around. They were way too slow to get rates higher. Now, in 2006 to 2008, there was a 2-year lag before they managed to get it under control. What's to say now we've already created the problems that are going to be in the next 2 years?
I think that's very interesting a question, and it goes behind a bit about why I'm not so confident of where rates will be, because I think we do have history with central banks of, as Mark says, and thank you for the correction, by the way, Mark, of them not actually being able to forecast that well in the future, but they are deciding what interest rates are. There's a wonderful episode in 2020 after COVID had hit. Mark and I were sitting there at one of our many employments, and we were listening to the Federal Reserve and Jerome Powell in particular. And he said that in August 2020, inflation had been averaging about 1.2, 1.3, 1.4%, really low. He said that he was going to introduce the idea of average inflation targeting. And the point of this was to say, look, maybe my target's 2%, let's say. I mean, people can argue it's 2.5%. This isn't an argument about what the level is. If it's 1.5%, 1.25% for 3 years, then we could have it running at 3% for 3 years, and then the average will be fine. And the obvious implication of this was, my goodness me, this is very bullish, on top of a market that had been moving quite strongly upwards. So Mark and I were very much aligned to buy risk and be long of the market. But at the same time, we feared that all this money flowing in would only lead to inflation at some stage, and therefore we should be looking to buy inflation hedges. We went into a contract that would benefit if the market suddenly reversed course and thought, oh my God, interest rates might have to go up. And so we had lots of risk on for the markets doing well, but we had a hedge on just in case they turned. Now, let's go through the CPI inflation numbers. So inflation numbers are 1.4, 1.3, August and September. March 21, so we're talking 6 months later, 8 months later, 2.6. July 21, 5.4.
Wow.
So not even the year anniversary. August 21, 5.3. So a year after he came out with this speech, inflation's out of control. And that just shows you, in my view, that central bankers have no clue about forecasting. Oh, sorry, I say no clue. That's unfair. They have the same forecasting ability as most other people. You've got to be more sensible about what's the market telling you, what's it showing you. And the market was clearly full of liquidity, as you say, full of opportunity there. That was a clear mistake and led to some of the issues we've had over the past few years of higher inflation.
But in fairness to them, there was the Russian invasion of Ukraine and oil prices doubled. Inflation that you just sort of pointed to them was just beginning to take hold because the oil price had doubled.
Yep.
That was bound to feed through into prices. It was a very difficult thing for them to sort of forecast. Clearly, you couldn't work out what Putin was doing.
I think that's right, but that's a bit like saying, if I take out everything that's gone up, inflation's actually very well controlled. You can't forecast things. You cannot. That's why I'm saying to talk with the accuracy they talk about is ridiculous. Look at what your eyes tell you. Your eyes tell you that money's flying into the financial system. Your eyes are telling you that the things are going fine. Why are you cutting rates so desperately?
I mean, to be fair, when they started to put interest rates up, they did very fast. But they were late. I agree with you. They were very late to do that.
And if I wanted to be even-handed with Powell, no reason why I should want to be even-handed. Don't have to be fair. He did, when they put rates up in the intervening period, they moved up quite sharply. And the world thought they were going to get a recession. Everybody thought he's made a big mistake. But he actually fine-tuned it very well indeed. So he's got one strike for him and one strike against him in that sense. But all I'm trying to make clear is we're all trying to work with this accuracy, which is not there.
You're giving him credit there, but I would ask a different question. I would say, is monetary policy impotent? The thinking behind that is if we've got the top 10% of US now control 50% of consumption, right? They are responsible for 50% of consumer spending. They don't have debt. They have cash. They've got the $7.5 trillion of cash sitting on the sidelines that you keep telling us about. Now, if you're giving a higher interest rate to $7.5 trillion, and those are the people that go out and keep consumer spending going, then it's the opposite of what you're trying to do. You're trying to slow down the economy and take spending out. But what you're actually doing is you're giving stimulus. So is monetary policy very different nowadays to how it was back when you guys had hair?
Well, I've always had hair.
Real hair, Mark.
That's a bit cheeky. That is a bit cheeky. That is a bit cheeky. But look, we're arguing about what might be another 1 or 1.25% interest rate cuts over the next 12 months in the United States. To give you some perspective, when the great financial crisis happened, when they started reacting to that, you basically saw the fastest ever interest rate cuts. Interest rates in America went from 5.25% in September 2007, and by December 2008, they were 0 to 0.25%. They cut 5.5% in a straight line, and basically they'd really pushed it from basically September, October, and December down to that 0 level because they had to do that. They were worried about deflation, and that's one of the things that central banks absolutely paranoid about getting deflation. We've touched on it before. That was the biggest problem for Japan for 40 years. They couldn't get out of a deflationary spiral. In its simplest terms, why would you buy something today if it's going to be cheaper tomorrow? Once you get in that cycle, it's very, very difficult to reverse, which is why a bit of inflation is good. And I would argue, as I've argued before, that 3%, 4% inflation is the right sort of, and a really good number for equities. If you look over the past, equities have performed very well when you've had 3 or 4% inflation and interest rates have been stable. Now they're in a position where you're going to get, let's be generous and say Chris's number's right and you get 3% inflation, but interest rates are falling. That is so positive. That's why I remain as positive as I have been, even more positive after last night.
This reminds me, the bulls sing the loudest at the top of the market.
And the bears squeal the loudest as it goes higher.
Fair. Grow your portfolio with IG. Invest £50 with IG and get a free share bundle worth between £40 and £200. Make your first investment into an ISA, GIA or SIP account by the 30th of September and benefit from commission-free investing as well as 4% variable interest on cash. Other fees may apply. Terms and conditions found in the show notes or on ig.com/UK. Start your investing journey with IG today. I think this takes us into the discussion around the portfolio. Okay, because we've talked about monetary policy there, that we've had a decision last night that arguably is very important. You've now got some visibility on rates going forward and the effect the White House is going to have on it. But the all-important question, what does this do to our portfolio, especially when at the top we've got a blockchain ETF there that's gone up 25% in 6 weeks?
Let's unpack that a little bit. So the first thing I'd say is just on that final bit about seeing these interest rates come through. People who know me well know that I am not very keen on central bankers. I think they follow the market. They don't lead the market. So what I mean by that, when we had that non-farm payroll number that was very poor, the market immediately went to 4 or 5 rate cuts. And all we've now seen is the Fed following the market. And the same happens in the situations where the economy is doing very well and suddenly the market starts to sell off, the bond market, and the Fed follows it. So I would be much more looking at what the market is telling me to really work out where the interest rate structure is going. And that the market is fine at the moment. It's very relaxed with this 5 rate cut view. So I think you have to say that generally the market conditions are going to stay pretty supportive for equities. Even if they only do 3, which is what I think they might do, they're going to do a couple first before you get to whether you're going to have a pause. So there's a nice little runway here still of the way the market moves. The real question is, what, therefore, does that mean for our portfolio and what we've got in there at the moment? And we've got this rest of September, which is this period of uncertainty for equities, although they haven't done badly in September so far. It's been a moderately up month, so that's good. So that's not been, they haven't raced away, but they've done fine. I would like to see how the US reacts over the next few days, because what you normally find, you mentioned earlier about 500 meetings that I've seen the Fed, or not the Fed, any central bank.
Yeah.
If I was to try to guess how many of those I got my instinctive reaction right on if I was trading, if I'm sitting there watching and I trade something, how many times have I made money? The answer is none. Because it's never right to look at the first reaction. It's always right after these big events to look how the market settles. And if I'm right, that people see it more as an insurance, then the market won't do very much here. If Mark's right and they see it as a step convincing them that we're still going and the bubble might be still moving upwards, then it's going to drive forward. So I'd like to watch on that for a moment. So net equity exposure, I wouldn't really be looking to change.
This does actually remind me of a story back in my portfolio management days. And it was sitting in the offices of Brevin trading till 10 p.m. at night over a big, it must have been the end of 2007, a big FOMC night on a decision. And it's the only time that I've ever been called into risk for having excessive risk and breaching all my limits. So I was sitting trading, over the 4-hour period. And that for me is my FA Cup final, right? I'm sitting in a hedge fund for, been there 6 months, absolutely loving life. And
Master of the universe.
Master of the universe. And trying to go with my instinct on what every single line and every word means that is coming out of Bernanke's mouth. So I must have traded 1,000 times, right? And 10 p.m. and made about $50,000 out of it, which, is a lot of money, but in terms of running a $100 million book, wasn't that much for the amount of trades that had gone in. Anyway, next day, come in, sit down. My boss says, Rich, can we go into the room? So I get taken into the room with the head of risk.
Naughty boy.
Naughty boy. They say, can you just tell us what your risk limit is? I said, certainly. I've got I run $100 million. I can be net long $50 million because it's a long short portfolio. That's right. Why the hell were you long $500 million of futures last night? And I obviously, my brain just went, there's no way that could have been the case. So I tried to work out what on earth I had done wrong. And they went through it and they showed me all the trades. And I said, sorry, where did you get this from? They said, well, it's from the bookings. We saw, your trades have been booked this morning when the guy came in, middle office, and this is your bookings. I said, yeah, he's booked all the buys and then he's booked all the sells. So it looks like I was long $500 million, but I was never long, more than probably 10 million at a time. And so they looked at each other, they laughed, and they said, okay, yeah, you can go.
What's known in the trade as squeaky bum time.
It was a horrible feeling. So I always behaved very much after that. With, something like a 25% return on the blockchain ETF, we've got a question which came in from one of the viewers, and it's, what factors do you take into consideration on how to time your selling or taking profits? What do you think, CJ?
Yeah, I mean, this to me is the question of the week, which is we've got something in our portfolio that's gone up 25%. And as I've said before, I'm a raider, which on the book, The Art of Execution, the raider is someone who takes profits a little bit too early. And so I'm itching to take the profit. Now, what makes me a little bit more keen on taking the profit is we bought it because we thought it would give us exposure to Bitcoin. That's why we bought it. We knew there were lots of other things in there, but it was the only way we could get that exposure.
And remind us why we didn't just buy Bitcoin.
Because we're not allowed to buy Bitcoin within the structures within the UK, although that is due to change, I'm reliably told, at the start of October. We bought it on that basis. There's a number of things in there which are linked to Bitcoin, but there's a number of things in there linked to other things. Now, since we bought it, Bitcoin, I haven't got the numbers here, and having been fact-checked by Spice already today, I better be careful. But I think it's small down. It's small down, Bitcoin. Yeah, we've made 25%. And the reason is because we have in there data resources, we have data companies, we have data management, we have all that sort of side of real estate, buying data centers. And that's been so popular with the AI crowd. How are we going to get our power? How are we going to get this energy? How are we going to get all this data? Oh, let's push these share prices up. It's pushed the whole of the fund up 25%. Now, this is one of my sort of golden rules, which I'm sure isn't right. I think also there are similarities. I don't wish to say that Warren Buffett got from me. I probably got it from him. But if you don't understand what you're doing and you made some money, then take your money. So to me, I made 25% in something which hasn't performed like I thought it was, like it should have done, which is the Bitcoin. So me personally, I'm very tempted to sell it. Now, you said, how do you make that decision? What do you do? Now, the question then has to be, and we'll get Mark's views on this. The question is, do you sell it all? Do you sell a bit of it? Do you cover how much your in price is? So you're just playing with profit? What is the right way? Everybody does it a different way. Let's hear from Mark, because Mark has a different way of looking at these things.
Let's cross over to Gordon Gekko to hear what his thoughts are on this.
Dear.
A reminder, of course, the movie Wall Street, greed is good.
So, I've been doing some work on the back, looking at what is then actually VanEck, crypto and blockchain. And the interesting thing is about a third of the portfolio is in data centers.
Wow.
Now, the reason it's had a big push in the last week or so is because there's been some fantastic news about data centers. You remember last week we talked about Oracle and having moved up nearly 40% in one single day. And basically that was because they announced that their data center business and the computing that they're putting into data centers was expected to rise 8 times in the next 5 years in revenue terms. 8 times. Now, if they're telling you 8, you bet your bottom dollar is at least 10, if not 12. So there's more to come of that. And there's been announcements all week, and including the trade delegation that's come over from America today and yesterday, talking about new deals for data centers. Now, you've got a third of this portfolio in the VanEck crypto and blockchain ETF is in data centers, exposed exactly to that. And growth is going exponential. That means it's absolutely
As is
rocketing.
the share price.
And the share price is lagging. I would say is lagging.
Lagging up 25% and it's lagging.
Yeah, but you see,
he's got Trump derangement syndrome, this guy.
That's not what we bought it for, though, was it?
that's irrelevant. You've got to assess what you have in there. Now, we should have looked more into what we had. Right, so that's our bad. Okay, as the kids would say, that's our bad.
To be honest,
It was his idea.
My stock.
It was your stock, and you didn't even know what it was. So the great thing is, but better to be lucky
than good, as I said last week.
Absolutely. So now we have this play on data centers, a third of it, and including the top 3 stocks in the portfolio are all exposed to this area. And when something goes exponential, I mean, I was looking back at history. Typically, you can get anywhere between 3 months to 12 months of this move. The raiders, they're in and out. A connoisseur like me, basically, what I would normally do is when I get to a point where I've doubled my money, I'd take my original stake out and I'd run the rest for free, effectively. We're not there yet, obviously. We're only up 25%. If it were to go up 100%, then I might be saying, well, let's sell half of it and go on. But I do think, genuinely, because of what we've heard in the last few weeks around Oracle and around data centers, this game is only just beginning. Remember, last year it was all about the Magnificent Seven taking advantage of AI, beginning to spend money on that AI, investing billions and billions of dollars into new AI. Well, this is the next phase, as we said when we talked about Oracle last week. This is showing that the spend from AI is spreading into other areas, and it is now going very heavily into data centers and we've got a lot of beneficiaries in this ETF. And now we know it. We'd be mad to go, oh yeah, just because we thought it was Bitcoin, we're wrong. No, we've got data center exposure there now.
But we don't have crypto exposure then.
There is some crypto exposure in there, but it's mainly for a lot of the data centers are for Bitcoin and crypto mining. So actually, that's where you get your linkage there.
That's why they bought them in the first place within the fund. That's why it was bought in there. And a lot of these miners in Bitcoin are moving their computer capacity to data because it's actually more profitable to them to do it. And the question is, do you thank your lucky stars? Or do you say, no, we've now found a new case? And, I mean, Mark and I have been investing for a long, long time, and we would normally say, remember, it's different this time is not a good way to run. And we have just said, we just had Mark saying, it's different this time. I now know why it's going up.
No, I didn't say
I
did not say it's different this. I did not say it's different this time. What I've said is, there is, the emergence now of this money that's been going for the last 12, 18 months into things like Nvidia and their chips is now spreading to other people. And that profitability is now being pushed into other companies. And this ETF has a big exposure to it. I think we'd be foolish to sell any at the moment.
Okay, but the question of the week was, what do you take into consideration when to take profit? So when would you take profit in this?
When I see it go exponential, I've seen a 25% move. That's not exponential. It's when it doubles and then doubles again. And we talked in the earlier episodes about people getting out too early in bull markets. You've got to run that last 6 months of a bull market is where you make most of your returns. And we're 6 weeks into this?
Okay, so is it a time or is it a percentage?
It can be both, but ordinarily, I think you have to look at it in the overall context of what's going on elsewhere in the world. I'm bullish of the US equities. These are largely US equities, and they are basically have exposure to AI. I like AI. They have exposure to the US and everything that's going on there. And there will be beneficiaries of the one big, beautiful bill that we've talked about before. That's all to come. And now they're beneficiaries of falling interest rates.
So how would you answer if I was to say, if we look back at the share price, I haven't got it in front of me at the moment, and therefore I've got a bit
it's up another 5%
data
this
issue.
morning.
Yeah, so I'm not that short term. In February, it was trading at something like £6.
Mm-hmm.
So it's now trading 11 quid. So it's got 100%.
Yeah.
So you've got 100% already on it. Now it's only just since we've owned it, it's gone up the 25%, but it's actually had a bloody good run from those low levels and pushed all the way up there. Now, I'm torn a bit. If my gut feel is we stay with it, but it has done a lot.
Has it taken out its all-time high?
It's very close to it. It's very close
hasn't
to it.
yet?
No. It's close to it. It's close to it. It's virtually
but the all-time high was several months ago.
It was set in November, but it was set when everybody loved crypto. So Bitcoin was trading $120,000, and every man and his dog was buying crypto. So that was a peak for the crypto bit of it.
Yeah.
Right. That's come right down now. So those strategies aren't there. But now it's the data center stuff that's moving. So, I mean, I don't know if we want to bring it together at that point, but I personally think that we stick with it for a bit longer, and I'll sit on my hands and keep my mind away from making that forced decision.
Is it a waste of time to take 1% off? Because you said that you take your original stake. Now
when it doubles, I'll take 5% out.
Right.
There's no way that I'm going to still be as chairman holding this stock for that long. But I do. What I think is a little bit is more persuasive is we haven't taken the highs out. We need to take the highs out. If we take the highs out with an exponential type move, then I'm going to be taking this off, and we're going to be saying it's the chairman's fault when it triples over the next week after. But to me, it's really difficult, just summing up to the questioner, it's a really difficult thing to work out. Everybody does it differently, but I have a tendency to sell too early. So I'm going to try to be a little bit more patient here and let it run a bit. It's done wonderfully for us. Let's see what the next couple of weeks bring, but this is not a commitment for the next 6 months.
The other thing I would say is it is part of a portfolio. It is 5% of a portfolio. It is arguably the only real sex and violence, apart from maybe some NASDAQ, in that portfolio.
The mining has its time.
But it's performing sort of middle of the road. It's not doing as well as many of the other markets. It's doing fine, but it's not shooting the lights out. And I would say that if you are going to take something that's higher risk out of the portfolio, you want to put it into something else that is also high risk.
Spoken like a true bull. This is a committee, so the committee.
And you'll be putting it into. I know you'll put it into cash because
This takes us into a wider conversation about where we are in asset markets, because we made 3.46% in 6 weeks.
So we're 3.46, which is up 80 basis points to almost 1% up from last week.
And that we had benefit from the Nikkei. So Nikkei up 1.9% in the week. India up 1.55. Our S&P 500 GBP hedged, of course, is up nearly 1%, as was the Russell 2000, a great addition 2 weeks ago. The underperformer is the DAX, and that has been the continual underperformer. We've now lost 3% in that since initiating the position. But overall, where do we feel assets are? Because for me, I'm like you, I would be taking profit too early. For me, everything just feels a little bit excessive, rational exuberance that we've talked about in the past. We're trying to make 10% on the year. We've made 3.5% in 6 weeks. Is it time to be buying more risk and putting more risk on, like you say, or is it time to consolidate for a little bit?
I mean, I am very happy with the risk we're running. I would like to buy any dips we see. I've been very vocal about liking the US, and there are lots of naysayers, not least in this room,
Naysayers, wow.
about
now,
the
now
US.
it's getting knifey.
And
now we're seeing our friends, aren't we?
The end of US exceptionalism, I think, was being thrown around.
Yep.
Certainly before we started this podcast. And what has happened in the last couple of months is that people have realized the US is still a fantastic place to invest. It is still the best place to invest and get exposure to AI, and it's got the benefits coming from the rate cutting and the one big beautiful
But the
bill.
dollar's
and
crashing.
so that's irrelevant.
Well, it's not,
Not
because
if you're a
you're
US
buying
dollar
US
assets.
we have a hedged product.
So but
We
not
have
the
a hedged
Nasdaq.
product.
The Nasdaq isn't. It's
Or the
interesting
Russell
to look at the
2000.
Nasdaq's actually only made since inception 1%, and that's because the dollar's moved and hurt it a little bit. Now, the exceptionalism, the US exceptionalism, I don't think any one of us has ever doubted that the stock market, the companies are excellent and doing very well. That's never been an issue. So I'm trying to, I'm going for the defence here. Well, my lord, I'm going for the defence here. But what we've argued is the currency is the problem. And I still don't see why that isn't the case. I mean, when I look at the S&P 500 in dollar terms this year, it is just now at the peak it was at back at the start of the year, whereas all these other asset classes are up 12, 13, 14, 15%. Now, the big question is the dollar from here. Totally accept that because it's had some weakness, but maybe that's not going to continue. I personally think it will. However, no one should be doubting the excellence of some of these US companies. I totally agree with that.
Is it priced in?
Well, my personal view, Mark will be really upset when I say this, is I don't think it is in those Mag 7 names because, as we were saying before, if they grow their profits by 20% each year, then what looks expensive today in their price per earnings ratio will look not very expensive going forward. And you can see those earnings quite visibly. They're not on 90 times, 115 times, the Palantir type rating you were talking about before.
Which has only gone down.
They're not, then yes, and that's been a great short. They are holding at the right sort of level. My worry is more about the rest of the US. And that's where Mark and I disagree a little bit, in that I'm not a fan of the big, beautiful bill. I've not got Trump derangement syndrome. And therefore, I don't think everything he does is going to work. And if it doesn't work, then you can have these 7 companies that are doing really, really well, and the rest is a bit underneath. And that's my only issue with it.
But my point is, I think that some of this benefit the Magnificent Seven have had is going to start spreading out into the rest of other companies in AI first, but also into the broader economy, which is one of the reasons I wanted to buy the Russell 2000. They are some of the biggest, historically, small and mid-sized companies are the biggest beneficiaries of interest rate cuts. As I said, they tend to have more debt than the bigger companies. They tend to have to go to banks to borrow money rather than to go to investors to borrow money. And therefore, falling interest rates are very beneficial for them. And going back to the dollar, I don't disagree. I've been in the, believing like you do that dollar is going to be weaker. My fear we're getting too bearish of the dollar now is that if I'm right and growth begins to accelerate into next year, which, by the way, is not what the Federal Reserve is saying, but that's what my own and that's what I think the stock markets are telling you. The stock markets are telling you that growth is going to be pretty good in the next 6 to 12 months. Then you want to be in US assets. And that could draw money from other countries and other investors back into the US. I mean, the dollar could actually at least stabilize here, if not go up a bit from here.
But there's an inconsistency there, isn't there? If we're being totally honest here, there's really consistency there. You're saying I'm comfortable with it because I think the growth's going to come through stronger than expected.
Yeah.
But if it's going to come through stronger than expected, I can get it at 5 rate cuts.
Oh, yeah. Oh, but hang on.
It's all the ways lead to bull markets. You see this, don't you? All the way leads to a bull market.
Look, I think the Fed, one of the reasons they absolutely nailed home that they were worried about employment or rising unemployment. And I think that they also, like many people, are beginning to worry about the impacts of AI on employment, and particularly in youth and younger people. And you're seeing that. The Goldman Sachs thing on AI a few weeks ago said that they expect over the next 5 or 6 years to see youth unemployment, that 18 to 25-year-olds, rise by 6 to 7%. So the way you then need to stimulate other parts of the economy to take up that slack of that rising unemployment that may be coming from AI.
Well, that all feeds into gold. If we're talking about a lower dollar and we're talking about more stimulus and lower rates, then gold. Why is gold not 25% of our portfolio like Jeremy Gunlax?
Well, gold hit a new all-time high again this week, as did silver. Did silver 14, 15-year high. So I don't disagree with you, and that's part of a portfolio.
Okay, so I'm putting forward that we sell blockchain and we buy gold.
I think 10% in gold is a good number. Is a good number. The thing about having 10% in gold, that's our biggest, one of our biggest allocations. What would you have in? You talked about before about having silver. Why wouldn't you have silver? If you like me, that's why I would be more of an advocate of buying silver, because if the economy gets better, the industrial uses of silver is quite high, silver should do better than gold in that environment.
Now, in the greatest spirits of being chairman of the Asset Allocation Committee, I now say we've got to that stage where everyone's throwing around. We've got to that stage where sensible conversation is disappearing quickly, and now it's all very rampant idea generation. So I think we've really decided nothing is the right way for us to be going forward today, and these will all fester in our minds. So next week we can rejoin the battle and work out what our next step should be. Before people start to listen to this and say, "Oh well, you don't make too many changes, you don't do that." This is what fund management is all about. The more we talk, the more we think, and the more we make sure we refine our best ideas. And the fact is, we're up 3.5% over 6 weeks against a 10% target. And we mustn't forget, we're not trying to be the best fund out there. We're not trying to be, 100% gain every year. We're trying to make 10% in a sensible way so people following this can feel that they can understand what we're trying to do and help them along that financial journey.
Now, thank you, CJ. I am just getting breaking news. We have a rate decision from the Bank of England. Going over to you, Spice.
Well, the market's correct. There's no change to interest rates in the UK. Sorry for those of you that have mortgages. We had that extra cut that's been delayed, and the vote was 7 people voted in favour of no change and 2 people voted to actually cut.
Okay, so as we see, the committee is important, that everybody gets a say every now and again. Hashtag sack the chairman. Thank you very much for joining us for episode 11. You can see the debate is heating up. The bulls sing the loudest at the top of the market, or is the bear just bleating? Now, gents, if we have any questions from the viewers, where should they write to?
The Art of Investing at IG.com.
We look forward to seeing you next week.